Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The opening bell at 1 hour and let's call it 10 minutes away. Equity futures down by 3% on the S&P, rolling over just a touch again. On the Nasdaq down by 3.2, on the Russell down by 3.7. That's the price action. Here are your morning calls. First up, Dan Ives of Wedbush cutting his price target on Tesla by more than 40%. Capitulation, just about. Citing a brand crisis created by CEO Elon Musk. That name is down again by 7%. Your second call from Morgan Stanley, downgrading large and mid-cap banking sectors to inline, saying Trump's tariff policy increases the risk of recession. And finally, UBS downgrading United Airlines to neutral, seeing a more challenging economic backdrop. That name is down again, and we are lower by 4.6%. Let's stick with the airlines. Savvy Sith of Raymond James upgrading JetBlue to outperform following the recent sell-off, citing, quote, low bankruptcy risk and an M&A floor, especially against the backdrop of negative buy-side and sell-side sentiment. Savvy joins us now for more. Savvy, plenty of negative sentiment, that's for sure. Going into these earnings from these airlines, before we get to JetBlue specifically, just how bad is travel right now? Are you already seeing the damage done to some of the consumer activity?
Yeah, good morning, Jonathan. Yes, you know, what you're seeing is in February, you saw kind of a slowdown in demand, and I think it was just a reaction to the policy uncertainty. You know, 1Q was also a tough period in terms of weather for consumers as well, and a bad flu season. So there's been a lot of noise, and we've definitely seen kind of a slowdown in kind of the February, early March timeframe. I will note that spring break, Easter travel, those appear to be still intact, very strong. So a bit of a mixed signal on the airline front, and it really seems to be around policy uncertainty. We've seen a bottom in those trends, but the question is, given the news last week and the stock market reaction, is there kind of another leg down here yet to come?
Savvy, there's a question around consumer versus corporate. And originally it was consumers that were showing some hesitant, but also on the corporate side, a bit softer demand. Where is the corporate traveler at a time where you hear about a lot of uncertainty about future plans?
Yeah, I think, again, if you look at corporate demand, it's still up year over year. So it's generally still in a good territory, but there was a lot more stronger momentum exiting last year and into January. So a lot of slowing down in the momentum we saw from the corporate traveler. And now, given these kind of tariff headlines and very kind of uncharted territory, it'll be interesting to see how that progresses. The thing with corporate travel is usually it's not, you know, it takes a little time for budgets to get cut. So I don't know if we're going to have an immediate clarity as to how corporate travel is going to progress, but we've definitely seen a little bit of kind of deer in headlights kind of action from corporate travel here in February, March time period.
Savvy, all morning John's been asking a great question, and so I'm going to steal it from him about what kind of guidance any of these companies can actually give, given that they have a real set of unknowns and, frankly, a real question about the blowback they could get from the administration. What do we expect to hear later this week from Delta kicking off earnings?
Yeah, Delta's not in a very enviable position because it's still very early on. Like, I think the benefit that airlines have is you are heading into the summer, and it does seem like summer is really borne out by leisure travel. So I think there's at least a stronger base to kind of hang your hat on. A lot of those, especially international summer trips, have already been booked. So they have some base to go off on, but it's not an enviable position, especially if they're trying to update their 2025 guide, given the level of uncertainty. So they're probably going to have to look at kind of past economic downturns and try to put in a kind of a lower floor to help guide. And again, the other benefit the airlines do have here is fuel has pulled back, and that's their second largest cost. So there are some kind of nice offsetting tailwinds for airlines, but this is not an enviable position, and I'm not sure how much comfort investors will have in whatever Delta is able to guide to.
Savi, much of this conversation is about domestic activity and outbound flights. Can we talk about inbound just a little bit? We've seen some big headlines coming through, several reports over the past few weeks about declining activity from Canada into the United States. I've seen a similar thing about travel from Europe into the US as well. Just what exactly is going on there?
Yeah, man, you're definitely seeing that there's a sentiment impact from some of the positions that the U.S. has taken, and you're seeing that most particularly in Canada. But beyond that, I think there is some kind of uncertainty around what travelers can expect once they come to the U.S. that's causing maybe some hesitation to book travel to the U.S. Now, I don't want to overstate it, but airlines live on the margins, and Air Canada recently mentioned that overall industry, the bookings for transborder is down about 10% over kind of the April to September time period. So there's definitely an impact, maybe not as great as some of the headlines make it out to be, but there is kind of an impact from kind of inbound travel, and especially looking into even the summer. What I would say is, since the pandemic, inbound travel has significantly underperformed trends versus pre-pandemic. So for U.S. airlines, I think the more important trend will be what happens to outbound demand, especially if the U.S. dollar weakens or if people are feeling a little less optimistic about travel.
Interesting. Savi, thank you. Savi Sith there of Raymond James. On the airline business and on JetBlue as well, I've always described the Dow as a weather report for a town no one lives in anymore. The weather report's dreadful, and it's a weather report people follow. It's raining right now. I don't know how many vacations you'd be booking with anxiety about the economy as high as it is. Equity futures down 2.7 on the S&P. Up next, Michael Gapen of Morgan Stanley, Megan Draper of Barclays from New York. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
60 minutes away from the opening bell, equity futures recovering just a touch, well off the lows. We were down by 5% overnight. At the moment, we're down by 2 on the S&P. We are down by 2.8 on a Russell. On the Nasdaq, by 2.1. With 60 minutes until that cash open, let's get you an update on some of the morning movers this morning. Here's Danny Berger. Hey, Danny.
Hey, John. It is still the Mag 7, which is under immense amount of pressure. NVIDIA down some 5%. Goldman Sachs saying that hedge funds had their biggest selling day on record since data going back to 2010. So it's no surprise some of these hedge fund darlings, like the big tech, like NVIDIA, have continued to be in free fall. It's not just tech, though, that is under pressure. The banks have had a rough go over the past 2 trading days. That continues today. Goldman Sachs down 4.4%. There's a note out from Morgan Stanley this morning downgrading Goldman, saying that this is the wrong kind of volatility. It is volatility that is bad for investment banking and management fees, which, by the way, we're seeing a lot of the big asset managers down as well on that very same narrative that fees when it comes to asset management are going to be under pressure. Finally, wrapping it up with a Reuters story over the weekend, Howmet Aerospace. This is a Pittsburgh company, and it supplies crucial parts to airlines, to different airplane manufacturers, rather, declaring a force majeure, meaning that they don't necessarily have to honor their contract because of the unforeseen event of tariffs. John, just underscores how supply chains might increasingly come under pressure as these tariffs kick in.
Danny, thank you. Appreciate it. Let's talk about that calendar. Those tariffs are kicking in over the weekend, a baseline 10%. Coming up later this week, just 2 days away, the reciprocal tariffs. So that's 20% on Europe, 34% on China. China set to retaliate a day later with their own 34% tariffs, and the same day we get US CPI. So lots of data, lots of tariffs, lots of Fed speak. Mike McKee has more. Hey, Mike.
Hey, John, we've got data coming up, but it's not till the end of the week, so it's going to be a while before the economy impinges on what people are thinking. But it is going to be interesting to see what we get out of CPI and on Friday, PPI. Right now, we're looking for a little bit of an increase in the producer price index on a year-over-year basis. Basically, base effects, but it is certainly possible that there might be some interim moves in CPI and PPI because of tariffs in terms of people stocking up ahead of time. What we saw, of course, were a lot of imports in December and January in particular. And we'd see tariffs start to hit first in fruits and vegetables, coffee, things that we don't make here and have to be bought on a short-term basis. A lot of toys came in, wine and beer, now that they're tariffing beer cans, the aluminum. And then we saw companies bringing in finished metals, industrial supplies, electronics, trying to get ahead of the tariffs. Some prices may have risen, but it's not going to tell us much about where we go from here. The thing that everybody's going to be watching, of course, is what's the Fed's reaction to everything going on in the markets. Not going to be a whole lot different from what Jay Powell said on Friday, but we do have a fair amount of Fed speak today, including a number of members of the Open Market Committee who are voters. Kugler, Barkin, Schmidt, Goolsbee, Bowman, and Solomon Williams all speaking this week, and they all vote. We get the minutes on Wednesday. Is it going to tell us much? I don't think so, unless there's some sort of liquidity problem, but the Fed still has the discount window and the standing overnight repo facility in case people need liquidity, so they could provide that without making any monetary policy changes. And I just want to mention one more thing. The Fed Board of Governors is scheduled to meet today, a closed-door meeting to discuss discount rate minutes requests. This is a standard, regular kind of meeting. They have this in between the Fed meetings every time. And there is no indication that it would have anything to do with any kind of monetary policy changes immediately, and it doesn't include the rest of the Open Market Committee. So if you get some tinfoil hat social media, it's not something to worry about.
Mike, thanks for clearing that up. Taking down the temperature just a little bit. Michael McKee there on the week ahead and on that closed-door meeting, which was scheduled.
Thank you, Mike. I had actually gotten a number of messages already saying, oh my gosh,
excited.
Is this it? They're going to end up coming out, staving off declines. Look, how much is this week's economic data going to matter at all? Will people look at it in the slightest? How much does any economic metric matter in any capacity at a time where policies are moving this quickly and this massively?
Things move quickly, and sometimes the Federal Reserve doesn't respond as fast. Do you remember the pandemic? Yes, they did a lot, eventually. But I remember one interview that Mike did with one Fed official. I'm not going to name them. And they sounded almost tone deaf in the face of what we were basically facing when the pandemic was shutting down cities across the world. So Chairman Powell went into the weekend saying, I'm not blinking. Essentially, that was the message from the Fed chair. That can change quickly, but you can hear that on repeat for quite a while before it does change. And then once it does, they move big and fast, as we've seen before.
Which is the reason why Andrew Hollenhorst over at Citi reiterated his call for 5 rate cuts just a minute ago through the remainder of this year. This time, though, feels a little bit different because there are dual threats of both inflation and a downside risk to growth. And you're coming off a pretty solid place when it comes to the economy. They're in a different place now than they were during the pandemic or in 2008.
I think also, Lisa, to build on that, I think they're scarred by the experience coming out of the pandemic.
100%.
21, 22, conditioned by the mistake they made then, and maybe they repeat a mistake this time, but a different kind of mistake.
So this is a reason why they are incentivized not to act rashly in response to this. If something breaks, all bets are off, and that's why people are watching the infrastructure of the system.
Joining us now is Michael Gapin of Morgan Stanley. Michael, welcome to the program. Let's get straight to it. Let's frame it this way. Coming into 25, where did you have growth? Sitting here this morning, where do you have growth now?
So coming in, 1.5%. We haven't made changes yet, but closer to zero from the direct effect of the tariffs that would go into effect last week.
So right now, going forward, Michael, how much are you actually pricing in all of what we've seen with respect to tariffs and using that for the new projection?
Yeah, I think so. The trick, Lisa, is, it's easy to pass through what we'll call the direct effect, meaning this is a tax on consumption. How would it weigh on consumption, trade, and imports and exports? The harder thing to understand right now is the indirect effects. What does it do for business confidence? What does it do for investment, hiring? And then the more equity markets are down, the more you have to ask, what about wealth effects on upper income consumers? So in some ways, Lisa, it's a lot more about psychology now than it is mapping the direct effect of tariffs on spending and trade.
So let's go hear from our psychologist in chief, one of the many that we have, Fed Chair Jay Powell, who often comes in and soothes markets when they get a little bit jumpy. And we have seen this time, Jay Powell does not want to do that. He wants to revoke his therapy license and say, look, I'm dealing with inflation here. You actually removed the risk of the Fed cutting, or the chance of the Fed cutting rates in the initial aftermath of the tariff announcement. Do you feel differently now?
No, it's essentially a recession call versus an expansion call. If we don't get a recession, it's going to be hard for the Fed to look through this inflation in the short run, right? So, and Powell essentially admitted this. He's like, we're going to react to the deviation from our mandate, meaning is it inflation that's far from its target or the unemployment rate that's far from its target? So if you're not penciling in a recession, then I think it's right to take out Fed cuts this year. At least the Fed's going to be on hold for the foreseeable future. And I think what I would frame this is the tariffs almost guarantee the Fed's going to be late. So they will respond to weakness in activity only after it materializes. So you probably need negative payrolls now to get the Fed to act. It's going to be hard for them to act preemptively.
Mike, back in 2018, we saw high yield seize up. no issuance at all in December 2018, and that was a moment that unnerved the Federal Reserve. Are you suggesting that maybe even with that kind of stress in financial markets, because of the upside risk to prices, they might not be able to move?
Yes, that's exactly right, because tariffs push up inflation now, they weaken activity later. So again, it guarantees the Fed's likely to be late. So if there's what I'll call a market dysfunction moment, yes, they will try and use some of their liquidity tools to maybe reduce stresses in markets. I don't think that's what you're getting at there. There's more like kind of front end market functioning, which they've addressed in the past. But in terms of the monetary policy easing and the monetary policy response to what's going on, yes, I think they actually need to see actual hard evidence that the economy is rolling over or we're getting job losses instead of job gains.
Mike, considering the size of the policy shift, I am surprised, I have to say, by the minimal downgrades that we've seen to growth and upgrades to inflation. I've heard numbers of like, let's say 4% on PCE. And some people are saying 0% growth. But at the same time, I'm seeing headlines that say the biggest policy shift we've seen in a century. 20% tariffs on Europe, 34% tariffs on China. 0% growth and 4% PCE is pretty tame with that in mind, isn't it?
So some of this, I think we have to make assessments of how long might these be in place, and is a 22% effective tariff rate going to come down? So yes, I think there's still a lot of moving parts to this. But John, what I would say is, again, it's the direct effect versus the indirect effect. When you get into the psychological component, right? Recessions are about feedback loops. And here, I think the two main ones are business investment and hiring, and then that wealth effect on the upper income consumer. If you play that out and assume, bad responses from those sides of the economy, then you're easily into negative growth and a sharper rise in the unemployment rate. So I would say most people are baking in the direct effects of this and perhaps leaving those indirect effects for later.
Interesting. Thanks for clearing that up, Mike. Appreciate your time, as always. Michael Gapin there of Morgan Stanley on the latest for the economy off the back of the huge policy change we've seen over the past week or so. Talked a lot about equities gapping lower. Talked a fair bit about this morning. This move in bond yields. Yields now higher on the session on a 10-year, up by 3. On 30s, up by 6 or 7 basis points. There is a long list of things that could be happening here, one of which is maybe people are avoiding dollar-denominated assets, even with risk assets cratering lower. That's one option. Another option is we're in a situation where you sell what you can and not what you want. That's another option. Lisa, the list is long, but the list is full of some pretty scary reasons for why treasuries aren't running this morning.
Yeah, I would agree with that. One not as negative interpretation of this is you are seeing equities off their lows of the session. You are seeing them retrace some of the losses from earlier, and you are seeing this bit of pushback. Kevin Hassett, the chief economic advisor to Donald Trump, speaking on another network in the United States and saying that more than 50 countries are negotiating on tariffs, that it is time to ease off the rhetoric a bit, that there are some great deals countries are bringing on tariffs, so maybe giving a little bit of hope that it's a negotiating tactic. Again, hard to know what to make of any of this, but it's making the rounds this morning.
He said the same thing over the weekend, almost verbatim. Exactly the same thing.
I'm not saying that
Commerce
this is what you do.
Secretary Howard Lutnick came out and said the tariffs are going on.
I'm just saying,
President
people
on
still
Air
have
Force
hope.
One, take your medicine.
Okay, you're right, but right now this is a market looking for reasons to hope.
Couldn't agree more.
And so how much is that feeding some of this? Yeah, I'm just trying to look at another option to throw in there.
We're still in this ridiculous situation we were in on Thursday, on Friday. We're still in it this Monday morning. New rules of the game or the start of negotiation. Depends on your market bias, but ultimately, the administration is telling you repeatedly they are the new rules of the game. I'd go one step further. The president has complicated negotiations even more by telling people this is not just about removing your tariffs, it's about giving us a plan to show how you'll get rid of the deficit. Help us get rid of the deficit and get rid of your surplus. You cannot do that overnight.
I'm going to bet you a pot of chamomile tea that in 2 weeks, we're going to be having the same debate and it's not going to be resolved.
I think we need more than a pot of chamomile tea, but I'll take that. Megan Graper of Barclays writing this. Core inflation will likely rise markedly over the coming months as tariffs are implemented. Labour report needs to weaken materially for the Fed to cut as much as it currently priced in by the market. Megan joins us now for more. Megan, good morning. Good to see you.
Good morning. Great to see you.
What changed for Chairman Powell over the last week?
Oh, I mean, things have become much cloudier. I think it's a much more complicated hand that he's been dealt. And frankly, we've downgraded our growth forecast, I think, in good company across the street over the course of the last 48 hours. So calling for two periods of negative growth in the second half of this year. We're calling for unemployment to tick back up to 4.6 by year end. But the bigger problem for the Fed is that we're calling for an increase in inflation. So it's up, 4% on the core CPI number by year end, 3.7 on core PCE. But to your point earlier, it's not really about where inflation is today. I think for Powell, he's looking out where is inflation a year from now or 2 years from now, and looking at his legacy as a piece of that.
You're running debt capital markets. How well supplied has this market been in the lead up to this? And what kind of issuance are you expecting in the next few months now?
Yeah, this isn't a liquidity event, and I think that's the net positive. So if we look at investment grade markets as really becoming a safe harbor for issuers and investors, we started out the year with a record amount of supply. An all-time record. Why is that? It's front-loading. It's not a nominal increase in funding needs, but it was a defensive posturing, I think, heading into expectations that this year would be choppy to navigate. And so you think about, the issuers we're talking to. I was on the road the last week talking to CFOs and treasurers. They're very defensively positioned heading into this, which net is a positive. They have extended their maturity profiles. You're watching EBITDA margins that are upwards of 30% still. I mean, it's far above 2004 highs. At the end of the day, they're appealing to investors who are flush with liquidity. So you talk to the buy side, the silver lining, the bright spot in the noise we saw in the last 48 hours is that investors continue to have cash to spend. Why? There's $400 billion of coupon income coming back into investors' hands this year. They've got record COVID debt maturing. That's all cash coming back into investors' pockets. And so we saw actually net buying over the course of Friday's session, as bad as it felt in other places, $2.5 billion of net buying. It's pretty astonishing.
Well, we've also seen deals pulled. Companies have been planning to issue certain deals and have decided maybe they ought to wait till another time because this might not be the best week in the world. Does that concern you, or is this just a timing for the best price kind of issue? And if they needed to and wanted to, they probably could, just at a small haircut to what they would like.
Yeah, I mean, in investment grade, we haven't had deals pulled, but they've been postponed. So we're evaluating entry points. And it's really three camps, I think, emerging as I talk to issuers. The first are yield-centric investors. And so you look at these moves in underlying treasury yields, it's more than offset the spread widening we've seen in investment grade. So net, in mid-January, you had, 478 on the 10-year note. 4% or sub 4% feels like a reasonably good entry point, even if you need to pay higher new issue concessions to appeal to some of that liquidity. Then you've got spread-focused borrowers. I think there it's a bit more defensive shelter in place, if you will. But in talking to what are largely bank buyers in that subset of issuers, many of them are already 40 to 60% through their funding needs for the year. So there's no real urgency here. We're not seeing any signs of panic. And then there are others that are just flush with cash, and I think maybe disappointed that business investment is slowing. But all in all, I think well-positioned and willing to ride out the storm.
There's a larger question here. You said that there's plenty of cash and the investor base is looking for good investments. A lot of the investor base used to be overseas, Japan in particular. And there's a real question, and John was alluding to it earlier, will some international buyers withdraw their interest from the U.S. markets on the heels of a whole host of different policies as well as currency differentials? Are you seeing any signs of that?
It's a great point, and I think it's something we need to continue to closely monitor. So retaliation may not be just as it relates to tariffs. It may actually be as it relates to investment in U.S. assets. And the largest growth of underpinning to demand in investment-grade credit has come from overseas investors. It's 20 to 25% of the market, so not insubstantial. On the new issue side, it's probably 15% of the order books that we're seeing. About 40% of that is Europe. About 25% of that is Asia, and then you've got 10% or so from Canada. The mitigants to that money moving away from investment-grade credit are really two or threefold. One is they already own 20 to 25%. So are you really working against your own book by paring back or not showing up to the new issues that emerge here? On the other hand, it's one of the few places you can source duration, and it's also the most liquid market around the globe. So $8.5 trillion of assets, it would be difficult, I think, to move back to their home markets. We did see 1 or 2 instances of smaller size real money pension investors on principle stepping back from the market last week. But it was a small fraction, and net 6.5 of net buying over the course of the week says it was a drop in the bucket in terms of those who pared back. But certainly something we need to keep an eye on.
It raises the question, where else do you go? Mike Gapen, who was just pinged me on the Bloomberg terminal, said trade's only a fraction of US GDP compared to other countries. The larger revisions may come outside the US, and it may be more of a global recession story than a US one. That's something we have to think about. I think over the last 2 months or so, we just talked about trade, looked at the market move. The market was basically the bias for everyone to frame their own view on what was happening at the moment. Equities were underperforming in America, outperforming in Europe. Everyone talked about the pain in the United States. Over the past week or so, we've only just started to talk about the pain abroad. In Europe, stocks down hard, Japan, in China. That's a new phase of the story.
This was what people thought would happen late last year when they were looking at a potential tariff regime. The U.S. sneezes and the rest of the world catches a cold. That was upended, partly because people, A, didn't believe that these tariffs would go on, and B, were so excited about the idea that Germany was going to spend money that it seemed like the whole world could be a brighter place with fiscal stimulus on some level. There is this issue of whether this is the right sizing and the unwind of some of that capital shift that we saw earlier this year.
Megan, this was a clinic. It's great to catch up with you. Thanks for your time. Thank you very much. Megan Draper there of Barclays. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. JP Morgan Chase CEO Jamie Dimon is urging a quick resolution to tariff policy issues. In his annual shareholder letter, Dimon wrote, "The quicker this issue is resolved, the better. Some of the negative effects increase cumulatively over time and would be hard to reverse." Dimon predicted an increase in inflation for both imported and domestic goods. The AP this morning reporting that Ukraine will send a team to Washington to begin negotiations on a new mineral deal. Both sides were expected to sign a deal in February, but that was derailed after the contentious meeting between President Zelensky and Trump at the White House. Ceasefire talks between the U.S. and Russia are also expected this week. Oil prices falling for a third straight day, down nearly 2%, after Saudi Arabia slashed its flagship crude price with an escalating trade war. Goldman Sachs has also reduced its forecast for the second time in less than a week. They now see Brent at $62 to end the year, down $4 from their prior view. And that's your brief, John.
Danny, thank you. Appreciate your time this morning. As always, up next on the program, we'll set you up for the week ahead. We'll get a final word from Anne-Marie down in the nation's capital. Live from New York, this is Bloomberg.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
Listen carefully. Can you hear the rhythm in the markets? In the dissonance that moves the Nikkei and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Live from New York City, equity futures down 2% on the S&P. On the Nasdaq, we're down by 2.1. Here we are, the Monday after the Wednesday, when we had this announcement from the President of the United States, and yet still this debate continues. Is this a negotiation or the rules of the game? The EU Commission President, Ursula von der Leyen, coming out this morning and saying that we will negotiate with the US on tariffs, but also saying that we'll focus on 83% of the trade not with the United States. She has talked about negotiating before. She has said if it fails, she will retaliate. We're just 2 days away from reciprocal tariffs.
This is a market in search of a narrative and in search of hope, given the fact that this market is really contingent on the idea that there is going to be some modicum of the old trade regime. And if it is truly upended, it has to be completely rethought in terms of price targets and in terms of returns going forward.
Equity futures recovering just a touch, bond yields higher as we count you down to the opening bell. Here's the trading time for the week ahead. At 2:30, President Trump holding a news conference with the Israeli Prime Minister. On Wednesday, reciprocal tariffs kick in. We get earnings from Delta 2. On Thursday, an inflation report plus jobless claims. Friday, PPI and UMich sentiment plus bank earnings. JP Morgan, Wells Fargo, Morgan Stanley. Let's get a final word from DC with Anne-Marie. AMH, negotiation or rules of the game? There's something to cling to every single morning. And once again this morning, negotiation or rules of the game? Which one is it?
Well, I think the administration is still trying to figure that out. I looked at what Kellyanne Shaw said, who worked under Trump 1.0 as a trade negotiator. She talked about how maybe it's a little bit of both. And if you want to be negotiating, you have to be uncertain and you have to be ambiguous. I take to what Kevin Hassett told reporters this morning, talking about the fact that he says the president right now is going to decide what the president wants to do. There are more than 50 countries in negotiation with the president. I guess one of them will be today. We'll hear what comes out of this meeting with the Israeli prime minister. Kevin Hassett goes on to say that they got a call from Taiwan. And then he has a message for Bill Ackman, Jonathan. He says it's time to ease off the rhetoric a little bit.
AMH, appreciate the feedback. Thank you. Attempted to turn down the volume, apparently.
Good luck. The way to do that is to come out with a deal. Let's see if that happens.
Up next on the program, tomorrow morning, we'll catch up with Peter Oppenheimer of Goldman Sachs, John Lieber of Eurasia, Julian Emanuel of Evercore, and Mira Pandit of JP Morgan from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off,
the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I think we're ready. Go.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Just about to see how much further we can fall. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, futures trimming some losses this morning, but the global market meltdown shows no signs of letting up.
Strategists continue to cut S&P 500 targets while Wall Street billionaires criticize Donald Trump's tariff strategy, with Jamie Dimon calling for a quick resolution.
But the president remains defiant, signaling he won't back down on tariffs, also dismissing fears of inflation and recession.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. I don't want anything to go down, but sometimes you have to take medicine to fix something.
Markets could see some relief as tariff negotiations take shape, that according to the White House.
But the fact is the countries are angry and retaliating. And, by the way, coming to the table, I got a report from the USTR last night that more than 50 countries have reached out to the president to begin a negotiation. But they're doing that because they understand that they bear a lot of the tariff.
Bloomberg's Anne-Marie Hordern has been traveling with the president this past weekend. She joins us now from Washington. And I believe it was also on Air Force One that he said, you know, I was elected on this. This was one of the biggest reasons I got elected. Of course, talking about eliminating trade deficits. And Anne-Marie, it's clear that he views this as his mandate and that what's happening in Wall Street right now is just collateral damage.
Yeah, the president is certainly digging in when it comes to his trade policy and doesn't want to relent. What was very clear is when he was talking about China, he said, I'm willing to make a deal with China, but they have to solve the surplus. We have a tremendous deficit problem with China. And you also talk about the deficit problem the United States has with the European Union. That seems to be a line in the sand, a red line for this administration. At the same time, Kevin Hassett, his National Economic Council director, was on talking to reporters again earlier this morning, making similar comments he made over the weekend. The fact that more than 50 countries have called the White House, are reaching out to the administration to try to get to a deal, which leaves us with this morning this question we have on whether or not this is a pure negotiation, or are these the new rules of the road, rules of trade, complete global realignment? I did try to ask the president that yesterday on Air Force One. That was a question he did not want to answer.
Anne-Marie, we thank you so much for your time, for all of your reporting. Of course, that is Anne-Marie Horder in Washington. Now, as we've been talking about, Wall Street strategists continue to cut their S&P 500 targets. We've seen Oppenheimer, Barclays, Evercore, Goldman, JP Morgan all adjust targets in recent days on fears of an economic slowdown. And last week, I spoke to Saba Capital CIO Boaz Weinstein about what he's thinking about when it comes to a possible recession.
I think about it in probabilistic terms. We talked about the probability of recession. There's also the severity, and the tails for how bad it can be are much fatter than in my prior experience when I was thinking about a slowing economy.
We are also seeing pushback on Trump's tariffs from the likes of Bill Ackman and Stan Druckenmiller. Ackman calling for a 90-day reprieve so the countries can negotiate and prepare, and the world can avoid a, quote, nuclear economic winter when fully implemented on Wednesday. Let's discuss with David Rosenberg, founder and president of Rosenberg Research, coming to us from up north. David, thanks for your time, first of all. It looks like futures aren't hitting quite as hard, but I guess the fundamental question behind all of this, are Trump's tariffs, you think, the end game? Does he want to hold them and use them to raise funds for the U.S. government? Or is this a negotiating tactic where he's hoping other countries will come to the table and lower their tariffs?
Well, the problem with every country, say, dropping their tariffs to zero is not going to solve the fundamental problem as far as the White House sees it, which is countries running bilateral trade surpluses against the United States. So this is far deeper than tariffs. You know, they were called reciprocal tariffs, but they're not reciprocal at all when you look at the actual formula that was constructed against each individual country or region. I mean, I think the EU has a 1% to 2% tariff against the United States. They're getting hit with a de facto 20% punitive levy, and it's because the way that the numbers were calculated, which was the bilateral trade gap divided by exports,
right?
Which is an overt attempt to create a situation where these countries have to have their trade surpluses with the United States completely obliterated.
Well, David,
so I don't know how do you negotiate that? How do you negotiate with each country? Governments of those countries aren't the ones doing the exporting to the United States. It's actual businesses. What are they going to say to their businesses? Stop exporting to the United States so we can get rid of our trade surplus with America? Like, so what are you negotiating basically? So it's a bit of a ruse in that it's not about tariffs. It's not about, all these countries can take their tariffs to zero. And the bilateral trade gaps they have with the U.S. aren't going to go away. And that's a fundamental issue for the administration because Donald Trump has been talking about the evils of trade deficits, or in this case, surpluses other countries have. He views them as a subsidy.
Right.
So he wants them totally eliminated. So when I hear the words coming out of the White House, well, 50 countries want to sit down at the table to negotiate. Negotiate what? How do you're going to negotiate basically a total upheaval of the global trading order? I guess that's what these discussions would have to be about.
Right. So, David, we've reported how incredibly difficult it would be to eliminate trade deficits. But in your view, I mean, if it's not tariffs that this is about, if it's about trade deficits, where does that leave the market? Because if we're just chasing something, the administration is chasing something that might not materialize. And it seems that the Trump administration, as they've said repeatedly, are not concerned about what's going on with the market. What does that mean for investors?
I think that it means more of the same of what we've had over the course of the past couple of days. I don't think anything's going to zero, and you've had sentiment washed out dramatically. But keep in mind that despite the carnage, for example, in the stock market, we went into this thing with a 22 forward multiple. Now we're at 19. We're still above the long run average. So you have to see, I think, more valuation adjustment in the stock market. Of course, none of us know what the ultimate impact is going to be on the E. We still know that although there's been a tremendous pullback in the market in short order, it's still not a cheap market. And then, of course, nobody knows where the E is going to be. So we're left in this bog of uncertainty.
David,
So what do you do in a bog? What do you do in a bog of uncertainty? You probably want to move into cash bonds and even probably golds, like all the classic safe havens for the time being.
Yeah, David, one question I have is you have people revising their forecast lower for the S&P 500. You pointed out the uncertainty around earnings, but you also have economists now bringing down their forecasts. You have Goldman, for example, rising their recession probability to 45% and growth down to 0.5%. But this assumes, David, that the April 9th tariffs don't take effect in their entirety. Why are so many strategists, economists, investors not taking the president at face value anymore, despite how much we've seen an escalation?
Well, I'm not so sure that I saw that out of the various Wall Street economists that you've discussed. I think that they did factor in the tariff staying in place. What they didn't factor in is what sort of further retaliatory measures are going to take place, because what we're finding out about China is that they're not going to back down, and they hit back with a 34% equivalent levy on U.S. goods on Friday. So the problem is that you can try and do your best estimating what's already happened. I haven't seen anybody saying, well, we're not assuming what happened in the Rose Garden last week is not going to be in our forecast. I think that's in the forecast. What's not in the forecast is what happened in the 1930s, which was not just the initial shock from Smoot-Hawley, but the fact other countries retaliated, and we tripped into a global trade war. And that has all sorts of other monumental second-round impacts right back on the economy. So I think that's really right now what the big question marks are. We've seen China hit back. We haven't seen what the EU is going to do. And the EU can hit back big time, especially on services. And so those are really the big unknowns right now. To me, the big unknowns aren't, oh, well, these countries are going to sit down with the White House and start negotiating. Negotiating what? Everybody thought we had the negotiations heading into last week's reciprocal tariffs. So what are we going to negotiate, basically? That's not the issue. The issue is really how are other countries going to hit back, and we haven't seen that full brunt just yet.
David, you're going to stick with us. We'll ask you where the bottom is when we come back. I want to get a look at some of the stocks moving right now ahead of the opening bell. For that, we go to Bloomberg's Bailey Lipschultz. Bailey?
Everything is down pretty much, so keeping an eye on big tech under pressure, Tesla, Nvidia, Apple, you name it, under notable selling pressure. One thing I want to call out, guys, just hitting my inbox from the Morgan Stanley Wealth Management Global Investment Committee. They're talking about taking at face value the Liberation Day tariffs. They say, quote, if we knew this was the end game, we would be aggressively selling equities and calling for a recession-induced bear market. So you're seeing a lot of investors getting out of what were some of the biggest winners. Obviously, when a key member of the Trump administration comes out saying this is a Mag 7, not a MAGA problem, we're seeing investors really dumping anything associated with risk, presumably hitting some of those big high flyers, obviously exposed to these tariffs, but also just the sense that if valuations are going to snap back ahead of an earnings season, you're going to get out of the areas that had really been a safe haven.
All right, Bailey Lipschultz, great roundup. Stay close. That is Bloomberg's Bailey Lipschultz. A quick check on futures here as we count down to the opening bell on what is shaping up to be a very rough day. The S&P 500 down 2.8% in the pre-market. If we have time, I would bring up the bond market right now. 10-year Treasury yields up 4 basis points. An interesting note from Neil Dutta saying that I think people are beginning to dump their bonds to raise cash. We'll explore next. This is Open Interest.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
All right, shares of Tesla have plunged in the market route, trading now around $226, but well below the price on March 19th. The stock was $235 when Commerce Secretary Howard Lutnick predicted the stock would, quote, never be this cheap again. Joining us now to talk more about how that has actually happened is Bloomberg Technology co-host Caroline Hyde. So, Caroline, here we are, lower than a level Lutnick said couldn't happen.
And Tesla CEO Elon Musk himself had said, time to buy, not according to the markets. Now, we've got some perma-bulls totally changing their opinion on Tesla now when it comes to the price target. Dan Ives still has this stock at an outperform, but he cuts it from $550, one of the highest on the street, to $315. We're down by almost more than 40%. And this is a mixture of repercussions and brand damage across the board. He's saying, look, Elon Musk needs to step up. He needs to bring his leadership. Not that Elon Musk particularly cares about what Wall Street analysts think a lot of the time. However, he really feels that the brand damage is being accelerated here. You could lose about 10% of future buyers, he thinks, at a conservative level. He's worried about China going more for their domestic players, for the NEOs, for the BYDs, rather than Teslas in particular. So he's really got a lot of anxiety around Tesla. But he calls it more broadly Armageddon. Economic Armageddon is what the tariffs are bringing us. That's why he also slashes his price target for Apple. He's still an outperform on Apple, but Apple being cut by more than 20%. And he's seeing that they are in the eye of the storm when it comes to their supply chain. And I think what we have to bring up is a tweet that he puts out there more broadly saying, we are setting US technology back by a decade.
Right.
Who wins? China wins.
There you have it, Bloomberg's Caroline Hyde. I know you have a big show on B-Tech coming up. That was Caroline Hyde reporting on, of course, that even bulls can change their stripes, Sonali. Just to reiterate that, Dan Ives writing a blistering note over the weekend saying that this Trump tariff Armageddon setting the tech world back, specifically the U.S. tech industry, a decade.
A decade. It's just incredible, to your point, because of what a bull he has been. But many people now capitulating. And we are back now with Rosenberg Research founder and president David Rosenberg. David, I want to point to your note this morning where you title it, Is the Market Oversold? You say yes. Is the bottom in? Likely not. So where's the bottom? How do you figure out how low, how bad things could get from here?
Well, you know, I spent the weekend fielding questions from clients about picking the bottom, to which my reply was, I'll leave the bottom picking to the proctologists because I think they do it better than the rest of us. You know, the sentiment is clearly washed out. And, you know, when the VIX breaks above 40, and we went back in the history books, and if you have a 12-month view, the market's up 96% of the time historically 12 months later. So the message was that we have a nice opportunity here. If you're willing to adopt a 12-month view, you know, everybody tells me I'm a long-term investor, I'm a long-term investor, I'm a long-term investor, yet everybody looks at their portfolio like every 20 minutes. So the question is, and I think the president maybe put it best when he said, you know, we're going to have to put up with some near-term disturbance or pain for the cause of the greater good, whatever that's going to turn out to be. But I think that you do have a lot of measures washed out. I mean, where in some cases you got some critical sectors of the market, you know, transports, consumer discretionary, the banks, all in bear market mode in the span of a week. Like what normally you take 6 months to do, you know, we've done it in this wild elevator ride just in the matter of the past few days.
Well,
what I'm saying is
let me
that
just jump in here and ask, because I think so many people in this market aren't used to default being anything but rise, you know, and we could get in a situation where even with a rally, you want to sell those because the market will continue to go down, 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 like 2000, 2001, 2002. Is that what you're expecting here?
No, I think that, you know, trying to pick the bottom in this bog of uncertainty is next to impossible. What I am saying is that if you're going to ask me in a year's time, looking at the indicators that I have at my disposal, I think the market will be up a year from now. It's like we're talking in you know, in January, February of 2009 when we were sinking into the abyss and the banks were getting priced for zero. I never want to touch equities again. And yet, you know, the VIX provided a tremendous buying opportunity signal if you had a 12-month view. You know, if you bought the stock market in January, you had to ride out another 20% decline to the March 09 lows. But if you had a 12-month view, you made money. The question is, what is your tolerance for pain near term? Because nobody can actually pick the bottom. And are you willing to take on a 12-month view and be patient? So I think very suddenly you've had, you know, a lot of appeal through the turbulence come into the market. But again, it depends on your time horizon. Do I think that we've hit bottom just yet? No. And I wouldn't tell anybody right now to jump into the market. But if you're underweight stocks and you didn't participate in the bubble and you're sitting with liquidity, you're getting a bit of an opportunity here. I would be tempted to sort of scale in gingerly. I would not jump in with both feet. And that's more of a message for people that have the liquidity and that didn't participate in the bubble and who weren't hurt by all this. There are people out there like me that weren't drinking the Kool-Aid at the highs. Ergo, I got the liquidity and the cash in place to look at this and to start picking my spots. And let's face it, the market has cheapened up a lot. We basically, I mean, you got these economists saying, well, 35% recession, 45%. I don't even know how they come up with a percent recession. You've got sectors in the market right now. And like I would say that the credit market and the stock market have basically crossed the halfway point in pricing in a full-fledged recession. A lot of work's been done, maybe not enough, but then you got some sectors that are already in an official bear market.
Right.
And those are the ones that you might want to, you know, start paying attention to and get your pencils and paper out, because I think we're building up. And if this continues in the next week, I'll tell you this much: if this continues in the next week, I'll probably turn very bullish on a 12-month view.
Well,
because the markets have a tendency to overshoot in both directions. We certainly did it at the highs, and we're going to do it at the lows. I'm not going to say we're there yet, but I think we're in a week's time or 2 weeks' time, we could be there.
Great.
Given how fast things are moving.
Great message from you, David. Really fascinating stuff to hear. Potential bullishness from such a world-famous bear. David Rosenberg there, Rosenberg Research, thank you for your time. Less than 12 minutes to go until the opening bell. We begin trading today with Robinhood's Stephanie Guild. Find out what the retail traders are doing. This is Open Interest on Bloomberg TV.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Well, strategists across Wall Street are slashing their S&P 500 price targets. JP Morgan's new year-end forecast has been revised down by 1,300 points. It now stands at 5,200 from 6,500 previously. The bank's bear case scenario is 4,000. Let's discuss this all with Stephanie Guild. She is president of Robinhood Asset Management and senior director of investment strategy for Robinhood Financial. So it's not just JP Morgan. You've also seen Evercore, Goldman, SocGen, and just in the past hour, Bank of America reduced their price targets. Obviously, there's a lot of pessimism right now. Are you feeling that as well?
Yeah, absolutely. I was doing all the math yesterday. The best number I can come to right now is like 5,400 on the S&P. I think there's a case you could easily make for 4,800. If you're looking at earnings growth expectations, like even though the S&P now is at valued at 18 times, that's earnings estimates haven't changed from a bottom-up perspective. They're still 11.5%. So really, if you assume that, you know, every 1% change in GDP equals 5% change in earnings growth. There's an estimate from the Yale Budget Lab that these tariffs are going to cost about 2% in GDP. That means 10%. That means very little earnings growth. And I think you could see 4,800 on the S&P. That's a little bit below where we are.
Wow. You know, really quickly here, because we have got to go to break in just about a minute, but, you know, where does the upside start to come in? You're seeing people start to sell bonds, right, to start to potentially raise cash. Is there a lot more pain under the surface? When does this become disorderly?
I think the bond sell actually, to me, is just changing your duration because rates have come down the long end so much, and they're taking profits there. But I think you just got to squash all the hope in the market. I still think there's hope that this is going to, like, end sooner than it really will.
Bill Ackman says maybe they'll just fire Lutnick and be done with it. It doesn't look like
just him.
Doesn't look like that's likely. Stephanie Guild is staying with us. We have futures that are obviously down now more than 3% as we head in to the open. This is Open Interest.
in this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we've focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
All right, we are moments away from the start of trading, and futures that were down yesterday 5% got a little bit better into the morning. We were looking at 2.5% drops, which is like the new up, and now we're back down again, just about 3 1/3% on S&P futures. NASDAQ futures down 3.5%. We're looking at drops of basically 13% over the last 3 days, including these futures, which makes it the third worst event post-World War II for stocks. COVID was worse, and the great financial crisis was worse, but otherwise we didn't see a 3-day drop this bad in 1987. Here you see the New York Stock Exchange. You're going to see travelers there, and the stock has done killer over the last 5 years, up 170%, well outperforming the S&P 500. But even travelers on Friday was down 8%. Dollar Tree ringing the bell to celebrate their 30-year anniversary. This stock at the NASDAQ is off about 10%, 11% this year to date, but over the last 12 months, they've lost half of their value. So bad for them as well. Katie, in terms of the stocks to watch, what are the individual movers that you're focused on?
Well, I have to go right to Tesla right now because it's leading the Magnificent Seven losses this morning. That's after Dan Ives of Wedbush cut his price target by 43%, following brand damage from Elon Musk's work with Doge. Shares currently down about 7%. Shonali, certainly a sign of the times to see Dan Ives changing his tune.
Yeah, speaking of Dan Ives, he also lowered his target for Apple, which produces roughly 90% of iPhones in China. Apple is down another 6.5% after the brutal 2 days already. You're seeing, Matt, a 3-day decline looking like more like 20% or more for Apple.
All right, finally, a check on NVIDIA, which just got cut to hold at HSBC and is now down more than 30% on the year. So we've lost basically a third of NVIDIA's value in 2025. S&P 500 on pace to enter a bear market at the close. Robinhood Senior Director of Investment Strategy, Stephanie Guild, joins us, or still with us, I should say. And how was your weekend? Was it, did you have like friends and family messaging like how quick can I get out of this? Do I need to sell? Should I dump everything?
I did. I definitely did. And people were asking me about what do I do with my kids' 529s? What should I do about my 401ks? It really depends on where you are in your life, but that's why you want to do things in your 529s like in age-based, right? Like hopefully it's reduced risk by the time the kid gets to college.
Yeah.
But I definitely I don't know if you're fully at the capitulation point, even though I am getting those text messages, because you've got put-call ratio that's still a little bit lower than where peak levels can be. You've got VIX at above 48 last time I looked at it. It can be a bit higher. So, I think Look, we just came from the unprecedented, non-recessionary, non-wartime deficit spending, right? Like the most we've ever seen, and now we've swung to austerity. And it's kind of like not getting enough sleep and eating, too much junk food. Like both are bad for you in the long run, but one at least is like, French fries at least taste good while you're doing it. So I just think we're like in an environment where there's still a little too much hope that this could end.
Right. Well, the president said it himself this past weekend that, it's not pleasant to take medicine. That's how he views what's going on in these financial markets with the S&P 500 set to close in a bear market if we stay at these levels. But I want to talk about what's going on amid, or rather on the Robinhood platform. You have a really unique view into what the retail trader is doing. We've been tracking the ETF flows and other measures which show that there's a lot of dip buying going on. Are you seeing that on the Robinhood platform?
We have for the last week or so seeing dip buying. Our customers have been selective. So where we have seen, there's been a favorite still towards Tesla and Nvidia, and where you have seen some trimming has been more in Apple and Baba. I think things are just a little bit more consumer oriented versus, Tesla's consumer oriented, but.
Well, speaking of consumer-oriented, I think one thing that's hard for people to gauge, you mentioned that stat, that Budget Lab stat over at Yale, 3,800 per household likely to be wiped out on the heels of tariffs annually. How much pain will the consumer start to feel as they go to the grocery store, as they go to their retailers?
I mean, it's going to take time, right? Because you had probably a rush of goods that have been coming in, and that has been affecting, it has made it look like we have greater imports than exports than normal. And so you probably have some inventory here to get through for a little while, but it's going to start feeling, it's a tax on every single person in this country. And I think that's what everyone needs to understand, is that this is absolutely going to slow down the economy.
I just want to show, on the Bloomberg terminal, if you type WSL politics, we've put up, Michael McDonough and his team have put up a chart of all the 3-day drops that have been the worst. And it actually goes the worst on the bottom up to the top. So I misspoke at the top of the show. 1987 was even worse than what we're looking at right now. Black Monday, and that 3-day drop. Also, the great financial crisis had a slightly worse drop. But this is worse in terms of 3-day drops than COVID. So it's pretty serious. Does sometimes selling beget selling? Do you think this turns into a self-fulfilling prophecy?
I mean, that's exactly what behavioral finance says, right? Like you hear someone say sell, and then it turns into, until you get to some point where you just say, it feels bad enough that you hear people starting to say, just buy it and hold your nose. I don't know if we're there yet, but I definitely think it leads to that. I'd say the difference between those times and this time is similar to COVID, it's kind of a man-made disaster, but different than those two times is that the Fed could step in, and there's no Fed to fight this time. They are stuck between a rock and a hard place. They have to care about inflation just as much as growth. And growth hasn't, they could be late if it ends up being growth.
Right. Well, that's where I wanted to go, because, you've seen that pricing for, I think, 4 or 5 Fed rate cuts at one point this year. Yeah. There was even a little bit of pricing for an emergency out-of-meeting Fed rate cut. But, I mean, to bring it back to that, what would that even do? Especially if the ultimate fear here is that we're going to enter a inflationary period. Why would you cut rates into that?
I think, Powell's been pretty clear that he's not ready to do anything yet. He's going to watch it, and he does admit that this could lead to slower growth, but also admits that this could lead to higher inflation. And so the scales are exactly balanced, in my opinion, for him, and that he has to wait to see what tips it. And growth has to be deep enough that inflation, he'll tolerate higher inflation.
Just to give a sense of how negative sentiment is today, I just want to show the components of the S&P 500, because you only have about 5 stocks in the green on the day. So it's brutal out there. Almost everything being sold off today, 3 days later. So if this is the case, what would be the positive catalyst at this point? What is the moment that this market is waiting for, given that recession odds are baked in regardless? Goldman's recession odds counts on tariffs being lighter than what Trump has said you'd see on April 9th. Yeah, it's incredible.
I think the market's starting to believe what has been said from this administration, and just trying to defend themselves now. Perhaps it always happens a little bit late. I think you know, we've been starting managing money actually for our customers last week on Monday. We actually started taking on more cash. Yeah, it's been an interesting time, but I think this is when you learn the most, and this is when you can kind of show your worth the most. So we've increased cash across our positions as of like last week, but I think what you're starting to see is that people are just starting to realize and understand what this all means. I think if you do actually start to see some negotiations, you could start to see like at least a bottoming. Like I don't even know if you just need to see like a calmer, like a bottoming before you start to say, okay, this is, at least we maybe reached the end.
Stephanie, we're so glad to have you today. Of course, that is Stephanie Guild of Robinhood. Now we're going to go to the big money also, the fast money, hedge funds, because they are being hit with some of their largest margin calls since the COVID pandemic. Bloomberg's Michael Ball reported on this, joins us now. You actually had a little bit of an optimistic note in this report as well. This idea that maybe the worst of the margin calls have been seen. When I talk to my sources across the street, they say they haven't seen disorderly unwinding yet. What would cause this to become disorderly?
Well, it's been a little disorderly Friday and again overnight. Generally, when you see the VIX getting as high as it has been, it means people are really reaching for protection or they're outright getting out of long positions. That's kind of what's been going on. They've been getting the tap on the shoulder and the cost of their margins has gone way up.
So how do we know when these hedge funds are at the end of their margin calls? How do you know if the biggest ones have passed and that we can start building a bottom?
Yeah, so we'll get that data delayed, but generally going into this, there was already a de-risking occurring as kind of growth outlook was weakening. So this actually hasn't been as bad as it could have been. But since the tariffs were higher than expected, we did have that sort of capitulation in the last couple sessions.
And Michael, one of the reasons we wanted to have you on was because you have this really interesting angle to look at what's going on in the options market. And when you take a peek at what the derivatives world looks like right now, how are folks actually positioned? You were talking a bit about margin calls, but even beyond the big hedge funds, have we seen the washout yet?
Because this has happened so quickly, we actually have a lot of open ground to cover now. Now, 2 weeks ago, as you remember, we were often talking about the JPM collar or this 5,500 level. But since we've crashed sort of below that, no one's been able to reset positions. So there isn't a lot of support. The 5,000 level right now in the SPX is where a lot of hedging needs to occur, and that has some gravity, which means that dealers will be buying and selling into that position, which creates support.
All right, Michael Ball of the Markets Live blog, thank you very much. Great reporting. Let's take a quick check on these markets right now. We're 10 minutes into the session and the S&P 500 briefly reaching session lows below that 4% drawdown level. Of course, we are in bear market territory if we end today's session around these levels. Volume off the charts right now when it comes to the trade. We'll walk through it next. And also coming up, Jamie Dimon says that tariff policies need to be resolved quickly as banks extend their slide. That's next. This is Open Interest.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, as we've been discussing, Dan Ives, he's one of Wall Street's most bullish Tesla analysts, slashing his price target for the stock by 43%, citing a brand crisis that was created by Elon Musk and President Trump's trade policies. Next up, we have Starbucks getting downgraded at Baird as it takes a more conservative stance on the entire restaurant industry in light of Trump's tariffs. And finally, we have Morgan Stanley downgrading the entire banking sector, saying that President Trump's tariff policy increases the risk of recession. Goldman Sachs is just one of the examples of those downgrades, Sonali.
And meanwhile, JP Morgan CEO Jamie Dimon is speaking out on the market meltdown. Dimon says tariff policy issues need to be resolved quickly, and he warns against a potentially disastrous fragmentation of America's long-term economic alliances. We're joined now by Bloomberg's chief Wall Street correspondent, Sridhar Natarajan. He talks about this geopolitics, the tariff threats, all adding to mounting pressures. You have Jamie Dimon himself making that potential recession call. JP Morgan's own earnings out this week. How much is Wall Street experiencing the pain that Dimon is talking about?
I think they're experiencing the pain not so much as what's happened in the last few days, but they're really worried about what lies ahead of them in the next few quarters. That is the big issue here. And you can be rest assured, like everyone's looking forward to Jamie Dimon's annual letter. He probably wrote most of these 60 pages well ahead of the tariff announcement, but a lot of changes were made in the last couple of days, and that's evident in his tariff commentary. By Jamie Dimon's standards, I will say this was fairly muted. Still, he does make the important point that the longer that this lasts, the negative reactions and the negative effects will accumulate. You will have a cumulative effect, and that will affect the broader economy. That will affect the country broadly, and most certainly the bank he runs and the rest of the banking sector.
I just want to point out we're looking now at a 4 1/3% drop in the S&P 500. So the Dow Jones Industrial Average is down 1,540 points. This market decline continues. At what point does Jamie Dimon come out and, show some real spine, re the Trump administration? Because you're right, his message was fairly measured, and he's not known for mincing his words.
Look, this is not the first act of, if you want to call it craziness, that we've seen in this administration in the last 2 months, right? And if you're talking about corporate leaders willing to come out and say publicly what they've been telling us privately, what they've been telling each other privately, you're not really seeing any signs of that happening. Whether you're talking about a tariff issue and you're saying when money starts to bite, you certainly expect a lot of these people to be more forthright. You've certainly seen that, especially with someone like a Bill Ackman. Look at his tweets going into the weekend and look at his tweets starting 6 p.m. last night. Big change in tone. And perhaps that reflection will be seen more broadly. And as you see more and more people willing to take it forward, willing to amp up their rhetoric on this, more people will come forward. But to realistically expect these corporate leaders to go out there and say they wholeheartedly disagree with this administration's moves and to express that in such a clear and forthright manner is perhaps still a bit of a reach.
Yeah, and we have Bill Ackman's tweet, his post on X starting that last night. You mentioned 6 p.m. That's, of course, when futures opened, and we saw that big drawdown. So he also called for sort of a pause heading into the April 9th tariff implementation. I don't know if that will happen, but it's interesting, Shri. I mean, you just think about where we were heading into inauguration. Of course, we had Bessent set up as Treasury Secretary, and there was this idea that, you know, he was going to be the adult in the room. He had a lot of Wall Street connections. I imagine a lot of the sort of folks that you speak to, those C-suites type people and the bankers that you speak to are trying to get on the phone with Scott Bessent and figure out what's going on.
They're certainly trying. If they can't get on the phone with him, they've certainly been texting him quite a bit. Not clear if it's just one-way channel. It does feel like that. It doesn't seem like Bessent is necessarily engaging with them. But part of that could also be, as some of our reporting shows over the weekend, that Bessent is not really one of the critical players as we navigate this period right now. As we navigate the tariff policy, it doesn't seem like he's a principal in the room. He's been playing a bit of a second fiddle, and that was evident in some of his comments to Anne-Marie last week, right after Trump's initial tariff announcements.
All right, Shri, great to have you on for our Wall Street beat. Shri Natarajan oversees the banks for us here, oversees Wall Street for us here. Coming up, billions of dollars of deals have been put on pause due to Donald Trump's trade war, and don't even think about going public in these markets. We'll take a look at that next. This is Open Interest.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
This is Bloomberg Open Interest. Let's get a check on what's going on in stocks. Just about 20 minutes into the session, we're down about 3%, a little bit more on the S&P 500 after back-to-back drops of 5% plus last week. So we're looking at the worst three-day drop, the third worst three-day drop since World War II after 1987 and the Great Financial Crisis. This is it, worse than COVID. Take a look at some of the stocks that are falling. NVIDIA down 4.25%. Obviously a huge heavyweight, as is Apple, down 4.6%. These are dragging down the S&P. Tesla falling another 7% right now, trading at $223 a share. And then you can see Alphabet, Google down 2%. So not doing so bad by today's standards. Neither is Microsoft. Palantir down 5 1/3. Katie?
Well, amid the meltdown that we've seen over the past week, billions of dollars worth of deals and IPOs are now on hold as the Trump trade war upends the global economy. StubHub, Klarna, eToro, Mountain, and Ategrity all pressing pause on upcoming plans to go public. Let's discuss now with Bloomberg's Todd Gillespie. And Todd, I guess it would be more amazing if you did have some of these candidates still proceeding and saying, I want to go public right now in this market.
Yeah, absolutely, Katie. I mean, right, some of these are kind of obvious right now. These are companies that, have long, touted their IPO plans. People are very much expecting them to go public at some point. But right now, if they can choose to wait, why wouldn't they? No investors right now are chomping at the bit to, to dive into a new IPO with all the risks that it entails. But, you have to ask as well, at what point do we see these kind of return to market? At what point will these roadshows get back on the road again? And who knows when that normalization will continue?
And some of these companies that we're talking about have been long-awaited IPOs. Klarna, for years, we're hearing from sources that these were companies that were in slightly better shape anyways. What do you make of the companies that are not in as good shape, that maybe have to take massive down rounds, that maybe not able to see the light of the capital markets for months, if not years again?
Yeah. Right, exactly, Shania. You've got a lot of startup. You want to think about the startup culture in this country. You want to think about the venture capital space right now. You want to think about the high-risk investors who are looking to allocate capital into all sorts of companies, biotech, all these companies that are already having, swaths of uncertainty from the policy environment. Now again, for instance, in the healthcare space because of RFK Jr. or whatever, and now they're getting added dollops of uncertainty from, the funding environment, from the public markets as well. So yeah, it's really kind of scary for some of these folks now.
It's pretty clear that you don't want to sell in this market, whether it's an IPO or, to an industrial buyer. I wonder, though, about overseas M&A. I mean, I've heard from private equity fund managers that they're trying to buy companies in France, they're trying to buy companies in Italy, and it's no-go because the administrations there just don't want to have it.
Yeah. I mean, certainly that's true. I mean, you don't know which countries are going to come and get some kind of negotiation down from Trump, kind of get their tariff rate cut. I mean, one of the things that I was actually looking at this morning was the share prices of the boutique investment banks in New York. You talk about cross-border M&A, you talk about Europe. I looked at Lazard. You look at Lazard's share price, it's lower today than this time last year. So all of that confidence heading into the election, all of that confidence of the election of Donald Trump, all of that, that boom time that you saw for boutiques going into 2025, that's been erased.
Yeah, feels like a long time ago, doesn't it?
Oh, yeah.
All right, Todd, great reporting as always. That is Bloomberg's Todd Gillespie. We're talking about, of course, these IPOs being delayed. You take a look at CoreWeave. It went public pretty much, I think, on the last day that you could have in this current market. It's still higher since its IPO. It's trading at $44 a share right now, so good on them.
Even with the sell-off we've seen in Newsmax, even they are also still above the IPO price. And I've got to say, a lot of the reason you saw Morgan Stanley slash their estimates for the banks, which start reporting on Friday, as we've been talking about, was the lack of those capital markets fees.
All right, let's take a look at what's ahead this week. Tomorrow, we're going to get a read on the state of small businesses from the NFIB. On Wednesday, we get Fed minutes from the March meeting. We'll see if there's milquetoast, as Jerome Powell was on Friday. Plus, higher U.S. tariffs take effect on imports from more than 50 countries and territories. You may have heard of those so-called reciprocal tariffs. On Thursday, we get CPI and jobless claims data. Trump has already told us there's no inflation, so we might as well not even look at that number. And we round out the week with U.S. bank earnings on Friday. Shanalia's Super Bowl, really looking forward to that. Coming up in the next hour, the CEO of Empower, Ed Murphy, talks about the state of your 401k. Then we have Bill Dudley on the possibility of a Fed intervention. This is Open Interest.
been offers before to take over Greyhound, but then in the midst of the pandemic 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically and think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority Bus Terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. New losses on Wall Street. The Dow is down 919 points, about 2.5% at the open. S&P off about the same percentage after entering bear territory over fears of new Trump tariffs. But the president isn't backing down. Writing on Truth Social today, he admonishes, don't be weak, don't be stupid, don't be a panican. He says that's a new party based on weak and stupid people. Correspondent Caitlin Huey-Burns.
The message coming from President Trump to Americans concerned was essentially hang tough. But that may be difficult given that those other tariffs are on the way, those even bigger tariffs on the way later this week, which could increase the price of goods for Americans. But through it all, the president has said that he is making clear he is not changing course.
Market strategist Matt Orton.
It's the extent of the tariffs and the uncertainty with respect to whether or not this is just a negotiation or whether or not these are actually going to be in place over the longer term.
Billionaires are weighing in. J.P. Morgan CEO Jamie Dimon warning that tariffs will likely boost prices and weigh down the U.S. economy. Hedge fund manager Bill Ackman urging President Trump to push pause. He warns the world's on the brink of, quote, self-induced economic nuclear winter. The clock is ticking for the Trump administration as it faces a federal judge's midnight deadline to return a Maryland man mistakenly deported to prison in El Salvador. Constitutional law expert James Sample.
We are very much on the precipice of a judiciary versus executive branch game of chicken that could very well turn into a constitutional crisis.
This case could be headed for the Supreme Court. A divided U.S. Court of Appeals has ruled 2 fired members of a board that help protect the jobs of federal workers can go back to their jobs. That reverses a judgment from a 3-judge panel from the same court. On the heels of severe weather that killed at least 20 people in the South and Midwest, 16 inches of rain. Correspondent Dave Malkoff.
In Frankfort, Kentucky,
The water level surpassed 48 feet overnight, challenging the record set in 1978. The rushing waters inundated homes and businesses.
It'll be Houston versus Florida going for the men's college basketball title tonight. CBS's Steve Kathan.
The University of Florida is gunning for its third NCAA basketball title. The school won back-to-back in 2006 and 2007. Coach Todd Golden knows the game is going to be tough.
Houston is an amazing team, and they deserve this opportunity. Obviously, they're going to have some great momentum.
Dow now down 1,062. This is CBS News. The Trump administration has ordered all national parks to remain open despite big staffing cuts.
The order came last week from the Department of the Interior, which manages national parks. It says any closures or reduction in hours need to be reviewed and approved. The National Parks Conservation Association says the order will endanger visitors and resources because parks are dangerously understaffed and underfunded. Hundreds of workers have taken buyouts or been fired. Wendy Gillette, CBS News.
Fresh off their series loss to the Phillies, the Dodgers will celebrate happier times at the White House today.
Strike three, ball game over, World Series over. Dodgers win.
They won during President Trump's first term. Several Black and Latino players boycotted the trip to Washington. Even shortstop Mookie Betts, who skipped in 2020, says he'll be there today. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming also on YouTube, so head over to youtube.com. Search Bloomberg Podcast. That's where you find us. Sell-off continues again today, although we are off the lows. Coming up, we're going to check in with Sri Natarajan, Bloomberg News senior finance reporter, get his thoughts on kind of these tariffs. What does they feel like on global Wall Street? Jamie Dimon's out with a letter with some comments on the tariffs. We'll break that down as well. James Abate, Managing Director and Chief Investment Officer at Center Asset Management, will get his thoughts on these markets. And Matthew Palazzola, Bloomberg Intelligence Senior Analyst covering the insurance business. We'll talk about, is that a place to hide out there in a market that is selling off here? Kevin Tynan, Director of Research at the Presidio Group, will discuss the impact of tariffs on the global auto business, continued weight on the auto stocks, including Tesla. So we'll check in with Kevin Tynan, formerly of Bloomberg Intelligence. Right now, let's get a market check. We'll do that with Mr. John Tucker on Bloomberg Business.
All right. Best I can say at this point, we are off the worst levels of a bad session. The S&P 500, though, still flirting with the bear market territory. All 11 major industry groups in the index, they are down right now. Worst performing stocks, they belong to Genuine Parts, auto parts company there, down close to 7%. And then Nike again, They make their stuff in Vietnam. Nike shares, they are down 5.5%. Now, overall, the S&P 500 down 2%. And we are being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around the clock. The Dow Jones Industrial Average down 958 points. Again, off the worst level of the session. The NASDAQ 100, 252 points lower. That is down 1.5%. Hardest hit in terms of percentage, the Russell 2000 of smaller domestic stocks. That is down 2.5% right now. As for the yield space, the 2-year pretty much unchanged at this point at 365. The 10-year yield is actually higher. That is up 6 basis points at 4.05%, which leads to the question, where is the money going at this point? And a warning from Dennis Gartman earlier today, the economist who used to run the Gartman letter, saying that around 10 o'clock or so, you might see some more forced selling with margin calls. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. I want to say hi, but I wish we could do it under better circumstances.
Hello.
Like the kind of thing you say to people at a wake when you haven't seen them in a while.
What do you say to people at a wake you haven't seen in a while?
Say, hi,
But
good to see
hey.
you, but I wish it were
Different
under
circumstances?
better circumstances.
Ah, okay. We'll work on that. Hey, everybody. Happy Monday. Alex Steele here alongside John Tucker
I go to a
and
lot of
Paul
wakes.
Sweeney. Just to your point, John, we're talking about where are people going. It feels like it's a larger U.S. de-risking environment. Does that mean the U.S. exceptionalism is over, or is this just a continued de-risking of U.S. assets? All right, let's take a look at some of the stocks on the move today, joined now by Bloomberg's Isabel Lee, Bloomberg Cross asset reporter. Speaking of, you're talking about Apple getting a downgrade.
Getting a downgrade, and that's why its shares are sinking lower by 5% today. So the price target is cut to $250 from $325. And Wedbush, Dan Ives, which is one of the biggest bulls, cites the Trump administration's tariff policy. So he said that the tariff economic Armageddon unleashed by Trump is a complete disaster for Apple, given its massive China production exposure. And as we know, Apple really sources majority of its supplies and equipment and all of those from China. And recall that the tariff rate slated for China is at 54%. Taiwan, where it gets a lot of those, is also 32%. So those two would really be devastating to Apple, its cost structure, and ultimately consumer demand. But here's the catch. Ives still has an outperformance rating for Apple.
I mean, yeah. I mean, you still got it.
That's his brand.
Yeah, it's his brand for sure. But the details there are quite striking. Dollar Tree, let's go through here. This also is getting some analyst comments today.
But I like Dollar Tree because it's inching higher by almost 8%. Citi basically turned bullish. So Citi anticipates that the higher across-the-board tariff will be positive for the discount retailer. And I got excited when I was reading this story because most of the tariff effect is on the negative side. So Citi says that the higher across-the-board tariff will be positive because he said that they added the price target. If Dollar Tree basically increases from $1 to $1.25 or $1.50 or $1.75, it will seem inevitable, but consumers would be, quote, accepting of the magnitude of change. And he acknowledges, though, that around 50% of the company's product is subject to higher tariffs. But still, he says that he believes that they can overcome this. He changed price target to $103 from $76. And the company may benefit from consumers also trading lower, so maybe more people will go to Dollar Tree.
Okay, very good. I don't know. We'll see about it.
I mean, yeah, there's just, I guess the reason behind it is a little disturbing when you take a look at the recession odds at Goldman and JP Morgan also ticking back up as well.
Still some margin pressure, I would think, as well. I mean, the cost of goods sold are going to go up.
Yeah.
So.
And MicroStrategy, let's end it here. So this is the Bitcoin proxy, right?
Bitcoin proxy, hedge fund proxy of Bitcoin. Basically, they're edging lower by 9%. MicroStrategy said, it will register an unrealized $5.9 billion loss in the first quarter, and that's after they adopted this accounting change that requires them to value Bitcoin at market prices. So the company now holds $41.8 billion worth of Bitcoin, and that fell by nearly $5 billion in the first quarter, and that's because we saw Bitcoin drop around 12%. So this was really long time coming. Strategy waited until the first quarter to adopt this accounting change. So prior to the change, Strategy has been classifying Bitcoin as intangible, meaning it's similar to trademarks or brand recognition. And this designation really forced Strategy to permanently mark down the value of its holdings. So that's why they had this change, but it's still not good.
All right, Isabel Lee, thank you so much. We appreciate that. Isabel Lee, cross-asset reporter for Bloomberg News. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcast. You think back to the election, to the turn of the calendar year into 2025, animal spirits. And nowhere did animal spirits run more rampant than on global Wall Street. Let's get some deal making. We're going to have easy money. We're going to have less regulation. We're going to have pro-business policies coming
Capital
from the
markets going to be wide open.
Yep, and let's go rip it. A little bit different tone here today, particularly punctuated by the letter from Jamie Dimon to his shareholders here. Sri Natarajan joins us here at Bloomberg News. He's a senior finance reporter. Sri, times have changed, my friend, over the last few months. What are your sources on Wall Street saying about deal making, IPOs? I see a big loan got postponed today to fund a buyout. So what's happening?
And they're looking for dog walking appointments. I mean, look, the sentiment is honestly captured by Isabel's story today, where if you look at the big take we have out on Bloomberg today, the headline literally is Wall Street is just collateral damage in Trump's trade war. Both of you are right. 5 months ago, when after the election, the biggest reaction in the markets came from these firms indexed to Wall Street, indexed to deal making, indexed to capital markets, who were certain that regulation was going to go down, all the obstacles were going to get out of their way, and it was going to be boom time for their business. The only problem was they were not taking President Donald Trump seriously, or at least President-elect Donald Trump, or the man who was campaigning to be president seriously, when on the campaign trail repeatedly he talked about his decades-long desire to change the global trade order. Tariffs are not something that's an idea that's been injected in Trump's head in the last week or 2 weeks or a few weeks before that. He's been talking about that for nearly 40 years. The problem was Wall Street refused to take that seriously. Now they're being forced to confront it, and the reaction hasn't been great.
And Jamie Dimon talked about in his letter, right, that there could be irreversible damage if it's not sort of turned around or changed relatively quickly. What did that entail? What was that really speaking to?
And to me, it was interesting that Jamie said that. Again, his annual shareholder letter is something that people look forward to, not necessarily the Warren Buffett letter, but with his stature as the elder statesman in the banking sector, every time Jamie Dimon has something to say, people pay attention. It's a 60-page missive, so most of it was written weeks and months in advance. But there was a lot of changes made in the last 48 hours, and the one that we're all drilling into is his commentary on tariffs. And he's clear there that the longer that this goes on, the negative impact will be cumulative. And that's what a lot of people have been talking about. Even if you start trying to change course, you try to negotiate. There was a commentary from a Goldman partner over the weekend who said it's really hard to put the toothpaste back in the tube once it's out. And that's the concern for Wall Street. If you are taking away the critical ingredient that businesses need, that bankers need, that the economy needs, which is certainty that gives you confidence, then what hope do you have?
Did the big global investment banks, just refresh my memory, do they provide earnings guidance typically?
They generally tend to talk about what their quarter is looking like. Okay. But the problem is when they start reporting earnings starting Friday and through the middle of next week, you will see that a lot of the numbers that they forecast, a lot of the numbers they talked about, which was especially relative to trading expectations and even deal-making expectations, they will match them, perhaps even beat them. But nobody really cares anymore because we do not want to know what they did between Jan 1 and March 31st. Exactly. Everyone is paying attention to how badly they will be hit going forward. Morgan Stanley is out with a note today downgrading the entire banking sector. And the breakdown there is interesting. They talk about how someone like a Goldman Sachs, you will see the immediate impact because the twitch reaction in capital markets and deal making is just, it's a snap. Yep. You see it, it's evident with respect to slowing down of loan growth in consumer books at banks or consumers falling behind on their loans. That is still something that's out in the future. And perhaps, if you're able to somehow navigate through this tariff, whether it's a negotiation, not a negotiation, whether he goes away with sort of the worst case scenario or dials it back a bit, that could have an impact on those things. But where you're seeing the immediate impact, just the fact that it is hanging out there, is deal making, is capital markets. And when that is shut, banks and firms that are indexed to that part of the business are going to bear the brunt of it.
Okay, but just in the last 10 minutes, stocks have just turned around. Now you have the S&P up, say 1.5%. You got bonds selling off hard on that back end, kind of out of nowhere. Isn't that volatility supposed to be good for banks?
Turnaround is a strong word because yes, if you checked
if we're
out,
down 4% and then we're up 1.5%, like that's the thing.
If you're checked out Friday evening and came in Monday morning and you're down 1.5%, that's still bad news. But yes, if your weekend ended at 6 p.m. Sunday and you were watching Bloomberg surveillance last night and you saw stock futures at down 5%, you started this morning down 4.5%, down 1.5% is not that bad. But again, this is
not
pure
good volatility.
This is not good volatility. This is not even informed market reaction. At this point, people are just trying to guess, how long can this last? Will there be a flip? Donald Trump himself has come out with tons of messages, including his excitement about meeting the Dodgers at the White House this morning. So maybe that's what's causing the positive market reaction. We just don't know.
All right, we'll stick with that. I think that might be the winning forecast there. Sri Natarajan, thanks so much for joining us and giving us the thoughts on kind of how Wall Street's trying to price in some of this uncertainty here from the tariffs. But again, we had futures down 4.5% this morning. Markets opened lower. Now they just flipped a bit higher here. So want some volatility. There you have it. We'll have more coming up. This is
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
All right, I'm John Tucker in the Bloomberg newsroom. complete reversal for the stocks right now, and here's the reason. This is a headline that crossed. This is from the Benzinga Newswire. Economic Council Director Kevin Hassett says Trump is considering a 90-day pause in tariffs for all countries except China. Again, the source here, the news desk at the Benzinga wire service. Right now, the S&P 500 turned higher. It's giving up those gains to some extent. Right now, up just 4 points, up 0.1%. The NASDAQ 100 is higher, up 140 points, up 0.75%. And the Dow Jones Industrial Average, it was selling off earlier, then it went higher. Now it's selling off again, down 0.7%. That is down 276 points on this headline. Haven't completely confirmed it. It is on the tape, as I just said, citing Benzinga News Desk. Kevin Hassett saying Trump considering a 90-day pause, so maybe somebody there did blink. 2-year yield right now, 5 basis points higher. That's at 370. The 10-year yield, huge moves here. That's up 10 basis points right now, 4.08%. And that is the very latest. We'll keep on top of all these details. Suffice to say, extremely volatile.
Oh, yeah.
Trading.
I mean, at one point, the 10-year yield was up like 17 basis points in a matter of seconds. We haven't seen that kind of move since 2022. And I think this all points to a VIX sitting at 45.
Here's the volume, by the way. The volume this time of day up 211% for the Dow, up 153% the volume for the S&P 500. That is remarkable.
Yes. And it also just goes to show, too, whether or not the headline is accurate, markets are going to move really fast based on headlines, and it's going to be a very, very volatile trading environment.
Well, now we're trading off again today. The S&P off 0.8%. The Dow off 490 points. That's 1.2%. So just in the last 10 minutes, we've seen, 4, 5, 6% moves in the market. It's just crazy out there.
Unbelievable. The algos definitely move for sure. All right, let's get more on the market and how to manage all of this. James Abate is Managing Director and Chief Investment Officer at Center Asset Management. Here's my really dumb question. Like, do you sell or is there a level to buy? Like, I don't know a more sophisticated question than that.
I don't know if it's a level. Let's think about what markets are doing, whether it's today, but let's look back at Friday. The selling on Friday was just indiscriminate. We had the highest volume day ever on U.S. trading. ETF volume accounted for about 40% of the volume, which indicates there was a rush to either hedge or delever positions. And I think one of the things that was telling to us is that even the safe havens like consumer staples, healthcare, utilities, even domestic infrastructure stocks participated fully in the drawdown and told us that even for the short term, maybe we might see some stabilization or a vicious counter trend rally like we're seeing this morning. The bottom line for us is this is a terrific opportunity, for true active management, because we think we're on the cusp of a potential market leadership pivot. We've been in an environment for the last 2 years where it's been the Mag 7 being the only source of returns, leading to some extreme concentration. In fact, we saw a lot of large cap core mutual funds have to change their investment policies to become non-diversified funds because of the top heavy buys of the benchmark. So going back to November, we came out very skeptical of the analog of just following the Trump trade playbook, despite the post-election rally, and stayed that way. But we've had a tremendous reset in prices. We've seen a rally in treasuries that I think, leads to opportunities in certain segments of the market, like the regional banks. You've got treasuries that have prepared their balance sheets, Fed cuts. We're the most bullish on regional banks probably since 1996. I don't want to date myself, because they're going to be growing and really be the leadership of the market, we think, because they'll be financing the industrial heartland build out. So our point to investors is now's the time to have a Main Street portfolio, not a Wall Street portfolio. And that's really a key thing for us.
So what is, I guess, the constituents of that kind of portfolio? What are the themes driving it?
The themes that would drive it are basically regional banks, utilities, other domestic infrastructure plays. I think the first thing to remember and why we were kind of bearish heading into this year was that markets were priced with perfection. You know, an equity risk premium that was essentially zero, credit risk was essentially dismissing any potential of disruption. For us, DeepSeek, the announcement of DeepSeek was the first match that was thrown on an overvalued Mag 7-driven market. The tariffs were kind of an accelerant. So I think the real key thing to look here for is on the other side of this trade, where we do get a rally, I would expect this to be an environment where the Mag 7 does not lead the other side of the sell-off here. And I think that will be confirmation that a Main Street-driven portfolio, not a Wall Street-driven portfolio, will be the one to lead us out.
But Main Street has also and will be hit. I mean, as we were just talking about earlier with Morgan Stanley just downgrading all the banks, yes, the ones with the capital market exposure get hit first, but the mid-sized banks, the regional banks, they're not going to be spared either.
Well, think about that. Or how much of that is already reflected? Many of these regional banks, whether it's Key, Regions, they're trading at less than book value. Many of them have seen an inflection in the return on equity. But most of the pain in the regional banks occurred when we had the sell-off driven by the failure of Silicon Valley Bank and some of the others. They have not yet been in the growth mode. Clearly, there could be some credit issues on the lower end of the consumer, but the concentration of commercial real estate problems is really dominated in the money center banks. So we would avoid the money centers and really, for the first time, have an opportunity further down on the capitalization spectrum with the regional banks.
So, how do you price in this environment we're in now, James? Do you think it's something that is going to be a longer-term issue for this economy?
Well, I think when we saw President Trump announce potentially that there'll be a stay on most tariffs except for China. I mean, China is the primary target and going to be the biggest loser. I mean, the fact that the market sold off on their retaliation to the U.S. on Friday is kind of, in a fundamental sense, immaterial. I mean, our biggest exports to China are soybeans, coal, almonds, and other things. I mean, the U.S. owns the asset that China and everybody needs, the U.S. consumer market. The key thing to remember with all of this is that, you know, we should stay away from blaming China. It was the U.S. multinational companies that closed down U.S. production facilities to gain access to cheaper labor and loose environmental concerns. And now they're the ones that have to reap the negative consequences of those technology transfers, as well as the intellectual property.
James, wasn't that the proper allocation of capital? Why produce something? Don't you want to produce it in the lowest cost environment to pass on the cost savings to U.S. consumers through lower prices and lower inflation?
Sure. Would you rather be unemployed and have access to a $79 flat screen, or have a job?
Who's unemployed? We've got full employment, James. James, we've got full employment here. Who's unemployed?
Well, it's the quality of the jobs. It's determining about the competitive edge that you can have as a country. There are security concerns. I think when you look back,
okay, so it's not economic; it's security.
It's both, actually. You have to have national security issues. I mean, let's forget that Chuck Schumer back in 2004. So
the fact that widgets are being made in China, that's a security concern to you?
That's not where Trump is going after. He wants the high value added things like automotive, technology, pharmaceuticals. That's where he's trying to gear it up. Toys, other things. Those are not really on the radar screen.
All the pharmaceutical companies are in New Jersey. James, thanks for joining us. Appreciate it. James Abate, Managing Director and Chief Investment Officer of Center Asset Management. Appreciate it. Matthew Palazzola joins us here, Bloomberg Intelligence Senior Analyst for Property and Casualty Insurance. Talk to us about the insurance business. I can't think of a way. I'm not sure how I would think about tariffs on an insurance company.
So there's a couple of impacts. The most direct is on auto insurance. So, and now obviously everything's changing by the minute, right? But tariffs on auto parts, cars will drive up repair costs, they'll drive up replacement costs, so that directly will impact auto insurance companies. So you get into an accident, the parts cost more to replace, then it's higher losses for the insurance companies, which also means higher prices for consumers.
So that means that what I pay for auto insurance will go up to compensate for that?
Potentially. So we've talked about this for a while. This has happened already, given the supply chain issues from COVID, which is still lingering for a while. Auto insurers are now in this kind of excess profit position. What they usually do is compete away those excess profits. So I was expecting before tariffs, I was expecting auto insurance prices to probably decline in the second half of this year. I do not expect that anymore should these tariffs take place.
Property and casualty insurers, are they defensive?
Yeah, so these are defensive stocks. It is a inelastic demand product, right? Companies essentially have to go out of business if they're not going to buy insurance anymore. You still need insurance on your home. You still need insurance on your car. We looked at, the Great Recession, right? Commercial premiums went down during that period, and that is not exclusively, but in a large part due to workers' compensation insurance, because a lot of people were unemployed. That insurance is based on the payrolls. So the top line for insurance companies went down because people were not employed. Companies were buying less workers' comp insurance. For home and auto insurance, premiums actually were kind of flat in those years, so they didn't go down. That economic impact isn't a dramatic impact on the loss side. It's more on the top line.
Right. Well, also, that was a different kind of setup in terms of like what was going to wind up being impacted. So if we wind up seeing these companies push through costs, can people afford it?
I mean, there's what we say in the industry is that, rate fatigue, right? And, I'm sure we're personally feeling it, but companies feel it as well. Another thing that is different about those two time periods is prices for insurance are higher now, not on a relative and absolute basis, right? So the industry was in a worse spot going into 2008, 9, and 10 than they are now. So there's more room to actually absorb higher costs.
About Warren Buffett, he looks out on his screen and boy, things are 10, 15, 20, 25% cheaper than they were, I don't know, a couple of weeks ago. And I got a lot of cash on my balance sheet. Are these times people speculate, what will Warren do?
I always hope he does something. Like during the COVID dip, I was really surprised to see them not really do anything. So, I wouldn't be shocked if they stay away from uncertainty, but I feel like the COVID uncertainty was probably, I don't know, who knows, worse than this uncertainty. Like I could see them move in and do something. They increased stakes in their Japan investments earlier in the year. Perhaps they do something like that. I would love to see them take advantage of it, but I don't think they're going to do anything that moves, their balance sheet.
Yeah, and also I guess the question is they were just totally different setups. Like COVID versus now, like how do you potentially quantify all of that? All right, really good to see you. Thank you so much, Matthew, for coming in and chatting with us. Matthew Palazzoa, Bloomberg Intelligence Senior Analyst, PNC Insurance on those defensive plays. All right, coming up, we're going to get to a play that is definitely not defensive, and that is autos. Kevin Tynan, Director of Research at the Presidio Group, will be joining us. I think the GM got a downgrade today. Again, another one from some analysts on Bernstein, downgrading the automaker to underperform from market perform because of the impact on tariffs. And taking a look at the market, Paul, we're down again. Now we're down by about 1%. Into the last 5 days, the S&P is off a full 10%. We're definitely trading around bear market territory. Potentially, we'll continue to follow that as we go. The bond market also selling off, though less than before. Yields up 10 basis points.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The market's wild ride today. The major stock averages, they are now lower. The S&P 500, 2% lower, down 106 points. The Dow Jones Industrial Average down 2.4%, 916 points lower. The NASDAQ 100 down 285 points right now. That's down 1.7%. And briefly soaring following the massive sell-off at the market open. The quick pop higher this morning. Have to explain this. This seems to be based on a headline that nobody could confirm. It came from Benzinga News Desk, which reported Economic Council Director Kevin Hassett says Trump is considering 90-day pause in tariffs for all countries except China. Now, that is being greeted with a healthy dose of skepticism. And in fact, the White House has issued a statement. White House tells CNBC 90-day pause on tariffs is, in their words, fake news. CNBC also, they carried that headline, but they did not attribute it to the source, which seems to be Benzinga News Desk. So that explains all this wild volatility we had just a matter of minutes. Any headline, regardless of the source, can drive this. So again, that speaks to the volatility we're seeing. S&P 500 down 2.2% again. The NASDAQ 100 down 2%. And the Dow right now, again, down 2.7%. As far as treasuries, the yields actually higher. 2-year up 1 basis point, 366. The 10-year is 8 basis points higher, 4.08%. Let me check the dollar. Dollar DXY right now, that is higher, up 0.2%, as you might expect. And we check the markets for you. I hope that was an adequate explanation.
Yeah, no, that was good. Although, to be fair, we don't know if CNBC said and attributed it on air. We're just talking about the lower.
Yeah, the lower, what do we call those in
lower
TV
thirds.
land? Chirons?
I say lower thirds.
Okay.
Okay.
But
You know
Chiron,
more about this than we do.
No, I think Chiron is a
'Cause you're a
completely
TV
appropriate name. Yeah, the dollar is higher. That's actually quite interesting because the tenor was very much like sell lots of U.S. assets, stocks, bonds, and the dollar. And now that dollar getting a little bit of that safe haven bid as well. All right, let's go to the autos because they ain't getting any love. You got GM stock is down by about another 3.7%. Kevin Tynan is Director of Research at the Presidio Group joining us to discuss all things auto. Kevin, I mean, how bad can it get for these guys? Like, where's the low here in the stocks?
You know, the interesting thing, Alex, is that if tariffs are a supply constraint for the auto industry, for the U.S. auto industry going forward, the last time we had a supply constraint from 2020 to 2023 was actually the most profitable time for the dealer groups and for manufacturers. So it kind of puts supply and demand, or has the potential to put supply and demand back in balance, add or utilize more of the domestic capacity. And this actually could be a good thing because we're not oversupplied with this narrow margin environment that this industry has struggled with for decades. So it's kind of interesting that it looks like an opportunity because you're talking about tightening up pricing or firming up pricing and expanding margins going forward.
Guys, jump in on that for one second.
Yeah.
But then we've heard like you have Ford, I think Volkswagen, also like Volkswagen is laying off some workers in the U.S. Ford is now discounting their cars in order to get people in the lot. That feels really different from 2020.
Yeah, well, the difference is it affects where 2020 was supply chain disruption across the board, right? Almost everybody was impacted the same because the supply chain is common through a lot of automakers. This is very different depending on what your production footprint looks like. So for those, right, for example, if you look at U.S. automotive factories in the fourth quarter, utilization was 65%, right? Where you're really looking for 80 plus to be, utilization for your auto factories in this country. So the idea is that you're going to have manufacturers that don't have enough capacity here to ramp up and are going to be penalized by that. And then you have the ability for manufacturers who do have capacity here that is being underutilized to ramp up output to make up some of that difference or those lost units. The way I look at it is this, right? 16 million units were sold in the US in 2024. About 11 million were produced here. So if you think about 5 million units in play, whether they get built or not built, there's the opportunity for domestic capacity to absorb some of those 5 million units. And when you think about it, 2022, which was the most profitable year for manufacturers and dealers, was only a 13.8 million unit market. So this can be profitable for manufacturers on smaller volume. And I think the headline is this takes units out overall, and that all sales are good sales, which isn't necessarily true. This will improve the quality of sales because supply and demand will be in balance.
Okay, that's what I thought too. That's why I'm very surprised that auto stocks have been trading down. Shouldn't this be the tariff environment? Should this not be good news?
Eventually it should be, right? If it goes according to plan, we're at 80% capacity for our automotive factories. The other thing too, and I think, Paul, the burden on the manufacturers because they have to right size or utilize more of that capacity, that lift is heavier for the manufacturing base than it is for the retailers. The retailers went through this process of supply constraint, fewer units, and have sort of rationalized their cost structure more recently than the manufacturers did, right? They idled plants, but they really didn't take out that capacity. So I think there's a little bit more of a longer lead time to get that production where it needs to be. And that's a global issue, right? Automotive capacity globally is a problem, and some of it needs to come out. So I think you're going to see a different impact on the manufacturing stocks versus the retailer stocks. And at the end of the day, the consumer ultimately just pays more for everything.
That's such an interesting take. Let me add on one more layer. What about the steel and aluminum tariffs and pretty much tariffs that's the input part? You mentioned that we could maybe absorb about those 5 million cars that were bought that weren't made in the U.S. What's the layer, though, on top of that when it comes to these derivative tariffs?
And I think that's an impact on the supply base, right? You're going to have some suppliers, smaller and depending, again, what your production footprint looks like, that are very much impacted, where there may be one or few big contracts where margins are razor thin, that this throws everything out of balance. But again, even if you think about that at the materials and the supplier tier 2, 3 going to be a problem, at the end of the day, that's supply constraint. And as you move through the value chain, that impacts the manufacturers differently or the retailers differently. If you think about the U.S. auto market going back, it's least profitable when there's the most inventory. And it's the most profitable when there's the least inventory. So we're moving to this period where we're coming out of a rebuild of inventory back to dangerous levels, I would argue. And that gets right-sized back to a 2-to-1 ratio inventory to sales. And it's actually a good thing longer term. There's going to be some pain right now in the uncertainty. But if it's according to plan, supply and demand come in balance and margins are just better.
Kevin, we've got about a minute left. Does this uncertainty in the auto business impact the changeover to EVs? I'm not even sure where we are there, but is there an impact?
Yeah, I mean, I think that was happening organically anyway. I think what this does, or this administration does, is it takes some of the demand levers out of there, which relieves some of the financial pressure on manufacturers to do a technology that has proven unprofitable. So I think you're starting to see that at state-by-state level in terms of the California Air Resources Board waivers. Virginia didn't go for theirs. There's talk about every other state saying, like, we can't go 100% EV or battery electric and plug-in hybrid by 2035. We're going to lose units to non-carb states.
Right.
So I think you're starting to see that pressure from government back off a little bit and let the market be a little bit more organic, right, and grow that demand naturally.
All right, Kevin. Kevin, great to talk with you as always. Kevin Tynan, Director of Research at the Presidio Group, joining us from New Jersey via Zoom. Appreciate getting some of his time. Markets continue to sell off here. The S&P is off 52 points. That's 1%. The Nasdaq's off 98 points. That's 0.6%. We'll have more coming up. This is Bloomberg.
Listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. A lot of moves in the world of technology, so we want to check in with one of our go-to voices, Anurag Rana, technology analyst for Bloomberg Intelligence. Talk to us about Google AI, Anurag. I mean, now you get the stuff at the top of your search, and for a lot of people, that answers kind of their query, and there's no need to go down and click on some other links here. How's that changing the search business in general?
Yeah, so far we have not seen a big dent in Google's market share in search. And I think this was one area where investors were really concerned about. You know, people are using ChatGPT more. So the question is, why do you have to go to google.com? But, you know, I would argue that, you know, Google Gemini is a very good LLM. And these guys will, when you have such a huge market share, I think they will figure out a way to at least keep bulk of their audiences, if not all of them.
How does the market environment right now, tariff issues and worries along those lines, like I get how it would impact the chip sector particularly, but what about like the Google and the Meta and the Microsoft? How does this affect what they have to put their capital in to do?
See, Alex, every day there is not a deal that is announced, frankly, scares me even more because business confidence, goes down quite a bit. So my view just a week ago was not as, you could say I wasn't as scared about tech spending as I am today, and maybe it's going to get worse a week from now. So the reason is business confidence really drives a lot of this CapEx growth, people buying new software products, people investing in upgrading their infrastructure. And if we get to a point when they don't know where the sales growth are going to be for big companies, Fortune 2000 companies, they're going to just pull back so strongly. So I think estimates are still very high as it relates to the tech sector across the board, whether it's software, whether it's services, or even hardware. I think that really needs to come down at this point.
So, Anurag, have you and your team made any adjustments to kind of your outlook for tech spend, or where numbers are going to be, or highlight maybe where some of the earnings risk might be out there, whether it's the hardware providers, the software providers, the ad-driven media companies like the Googles of the world?
Yeah, we did publish a note last week that looked at all these companies, and there are certain companies that are better equipped. Let's say somebody like a Microsoft, because they have a well-diversified business, but at the same time, I mean, they do have some search business, some advertising business. Seat growth is going to be an issue. So I mean, there is nobody that's immune, frankly, but the ones that are far more exposed to the small and medium business community, whether it's a Shopify, somebody like that has a far more, outstanding risk to their business model. And, same thing we heard from, you could see the Amazon stock price over the last few days, because their merchants, if they are not able to sell the products that they get from China easily, I mean, that, volume dries up very quickly also.
Does it get deferred or delayed or absent? Because at some point you can't delay spending on your technology infrastructure, right? I mean, there's still going to be that race to get ahead.
Yeah, fair point. But what happens is, listen, we're just in March, April, and at this point, and if you're going to tell me that 2025 is a washout and you shouldn't even think about 25, you're going to value stocks on a 26 basis. But I have no idea how long it's going to take for them to sign a deal between all the different countries that we have, tariff war going on with. So it can get really pretty ugly, over the next few months. And that has an impact on not just 25, but overall valuations. Remember, before 2 months ago or 3 months ago, everybody was talking about how tech valuations are getting frothy at this point.
So do most tech companies, refresh our memory, Anurag, do they provide guidance? And if so, do you expect companies maybe will back away from guidance? What do you expect this earnings period in terms of forward look? Because they could probably get a pass by saying, hey, we don't know what's going on out there.
Yeah, I do expect, some of that happening. Now, let's say a company like IBM basically says, well, we're going to grow at least 5% this year. Now, let's see what they say when they go out and, when they report results. Microsoft, on the other hand, will talk about their cloud business. Now, there are two things happening here. The AI cloud business is going to be very good. But on the other hand, the non-AI cloud business, companies may decide to pull back their numbers. So I think it's going to be very hard for these companies to give a good guidance either for next quarter or the full year.
And then to that point, which company is going to be the best barometer of that when they start reporting?
I think both AWS and Microsoft are going to be, because it's not going to be just their guidance for cloud. I think the comments about CapEx is going to really shake the market, because remember, in the last few months, all of them have said that they're going to ramp up their CapEx spending. Last time Amazon talked about it, that at the parent level, they're going to spend over $100 billion. Microsoft has said over $80 billion, and Meta has, said 60, 65. If these companies pull back on that, I mean, that's another leg down for, the AI infrastructure companies, whether it's the chip or the hardware or the cloud companies or so.
Here's my thing. If I'm a CEO in a company, how do I possibly know what my guidance can be?
I don't know. That's a great point. I mean,
how do they know how much they feel good about spending when there's so much uncertainty? I literally don't know how to read this earnings season.
They probably don't know what their customers are going to do. And
right.
I think Dan,
it is.
Yeah.
It is exactly like what happened in that first, month or 2 months of COVID, because nobody knew, and they saw we cannot give any guidance right now. I think we are in a very similar situation.
Yeah, I was going to say the same thing. It reminds me very much of that first quarter there. All right, Anurag, thanks a lot. Anurag Rana Bloomberg Intelligence Senior Technology Analyst. Always wonderful to talk with you. For our listeners in the U.S., here is a reminder, everyone, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now, with the S&P now up 0.1%. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We got you covered on all angles here on the market. We're going to break everything down for you in this hour with Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, on the latest with the tariffs from President Trump. Apparently, according to reports, there are 50 countries willing to negotiate. Is that true? What that winds up looking like? Then Mike McGlone, Bloomberg Intelligence, will talk to us about commodities and what's going on with oil at 60, and what do you do with gold. Gina Martin-Adams, and a Bloomberg Intelligence Chief Equity Strategist, will talk on the broad market. I mean, how do you even dissect earnings season this coming quarter? And then finally, wrapping it up, George Ferguson and Mary Ross Gilbert, both of Bloomberg Intelligence, will cover autos as well as clothing retailers. But let's kick this all off here with the Bloomberg Business Flash. And for that, we go to Charlie Pellet.
All right, thank you very much, Alex Steele. Happy Monday. Certainly got the A-team lined up for the 11 a.m. New York hour here on Bloomberg Intelligence. Stocks right now trading mixed. It has been a wild morning so far, and yes, we got you completely covered with what's going on. S&P, right to the numbers here, up 17 at 5,093 right now, up 0.4%. We've got the Dow Jones Industrial Average down 125 now, down 0.3%. The Nasdaq, meanwhile, up 159. That is a gain of 1%. Stocks swinging violently, wiping out a 4% plunge to rise more than 3% before turning negative. Now back in the green on the S&P, up by 0.5%. The 10-year 4.12%, with a 2-year right now at 3.72%. Gold down $37 the ounce, right at $3,000 even, lower by 1.2%. West Texas Intermediate crude down 1.2%, 61.26 a barrel on WTI, and Bitcoin at 79,175, up by about 0.4%. So the Dow lower, the S&P, Nasdaq, they are both gaining right now. Russell 2000 cannot ignore that, up 0.4%. Keith Lerner is Chief Market Strategist at Truist Financial, and on surveillance this morning, he offered this advice to investors.
After we have these really, sharp two-day moves in the market, what's notable in our work is the sharp two-day up moves tend to happen within the next 2 or 3 weeks as well. So you're going to see these swings back and forth. Each headline is going to be over-extrapolated, and there's going to be a lot of emotion. So I think using a prudent dollar-cost average approach into the market, it makes a lot of sense right here.
And he emphasized each headline, and that is precisely why you keep it locked into Bloomberg for the very latest. Tesla, meanwhile, continues to slide again, dropping below a price at which Commerce Secretary Howard Lutnick predicted they'd never fall to again. Tesla shares, they are trading lower now by just about 1.8%. Again, recapping, S&P higher by 35 points, up by about 0.7%. The Dow down 0.1%. Nasdaq up 1.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. Alex Steele here alongside Paul Sweeney. Crazy in our price action. I mean, really unbelievable.
I just walked down the hallway. We were down a couple hundred on the day. Come back, we're up a couple hundred.
Literally, and the stock market getting kind of whipped around here. Let's take a look at some of the stocks on the move today. We're joined by Bloomberg with Isabel Lee, a Bloomberg Cross Asset reporter. Let's kick it off again with Apple here.
So for Apple, it's not moving crazy. It's still edging lower by 2.5%. So Apple's price target was cut from 325 to 250 by Wedbush. So Wedbush, Dan Ives, as we know, is one of the biggest tech bulls. He cites the Trump administration's tariff policies, basically, and he said the economic Armageddon unleashed by this will be a complete disaster for Apple, who really has a massive production in China. I mean, recall that the current tariff slates China at around 54%, Taiwan around 32%, so it also produces and manufactures some stuff in a lot of those Asian nations. And the two will be devastating for Apple, its cost structure, and consumer demand. But he still has an outperform rating, so there is that silver lining.
Okay, I mean, he is the perma-bull, but so he's certainly reflecting. And if you follow his social media, he's been calling out this for a long time here, and calling out Elon Musk for losing his focus on Tesla, now on these tariffs and the impact on certain companies like Apple.
But I guess my question is too, like, at least for here, like it's passed through to your phone bill, right? So it's like if it goes up $100, like, are you gonna feel it?
I think a lot of people will.
I mean, if you're already paying $1,300 for a phone, I mean,
I don't know.
I see your point, but I think maybe if you're here in America, maybe not. But in China, where the competition from the local brands, maybe that makes a huge difference.
Absolutely. When it's not done through your carrier, that's a different kind of setup.
Exactly.
All right, let's go to Dollar Tree now. Different story.
Different story because this is one of the companies that will maybe benefit from this whole tariff war. Citi turned bullish. They anticipate that the tariffs will generally be positive for the retailer. They raised Dollar Tree from neutral to buy, and they say that, you know, they have the cover to increase their base price. If you're already selling at $1, what's $1.25, $1.50, or $1.75?
And they really don't sell at $1, but your point is still taken. I get you.
And then they said that consumers will be accepting of this change. And also, I mean, with this inflation, consumers will be trending lower, so we'll be expecting more footprint maybe to Dollar Tree stores.
That's one of the pushbacks from folks on tariffs, that they are not only a tax, if you believe that, as some economists do, but a regressive tax. It impacts the lower income folks more, and is that what you really want? So some challenges there for sure.
Yeah, when you talk about the recovery out of it, is it K-shaped, right? Which is what we talked about a lot during the pandemic. Rich get richer, poor get poorer at the end of the day, and you have that divergence. Let's wrap it up with MicroStrategy.
MicroStrategy down by around 5.5%, so they pared back some of those losses. But basically, they said they will register an unrealized $5.9 billion loss in the first quarter, and that's after adopting this accounting change. So the company's holdings of Bitcoin is around 41 billion, and it dropped 5 billion because of Bitcoin's 12% drop. So they waited until this quarter, the first quarter, rather, to adopt the accounting change. And prior to that, they were classifying Bitcoin as an intangible asset, similar to a trademark. So this one is probably for the better, but still investors aren't liking it.
Right. All right, Isabel, thank you so much. We appreciate that. Isabel Lee, cross-asset reporter, giving us the breakdown of this market. And again, we've got red and green on the screen here. The S&P is negative, the Dow's negative, but the Nasdaq's positive here. So whipping around, we'll stay on top of it. Let's go down to Washington, D.C. Nathan Dean, our person down there, Bloomberg Intelligence Senior Policy Analyst. Nathan, what's the feeling down in D.C. about how these tariffs are being rolled out by the administration, and maybe how much room there is for some negotiation?
Yes, you know, there's always room for negotiations. I mean, President Trump was posting on Truth Social today that, you know, that there's been conversations with other countries, all the countries around the world, in terms of trying to figure out what's coming next. But what we're telling our clients is that, you know, obviously headlines notwithstanding, you know, President Trump is committed to the cause of implementing these tariffs. And we're seeing very little pushback from Republicans on Capitol Hill. We're seeing some angst, if you will, amongst the lawmakers, but nothing really trying to say or suggest that this is going to stop and this is going to continue. So whether or not President Trump proceeds with these tariffs or they're pushed back or anything like that, this uncertainty in this market issue, if you will, is going to continue. So I think that we're in here for the long run, that this is what the story is going to be here from Washington.
Now, on the flip side, the tax package and the budget resolution that went through the House, went through the Senate passed it on Friday. What's going to be the combination now between the House and the Senate bill? And do we get something meaningful, like some tax cuts or something that will help support the economy?
Yeah, so what the Senate did is they passed their budget resolution on Saturday. It was 51-48, but it differs pretty dramatically from the House version. What the Senate did, and I'm going to pick on them just because I think the Senate plan has the better chance of success, is that it made permanent the Trump-era tax cuts from 2017, which would effectively cost $4.5 trillion. Now, what the Senate did is they said, well, let's just presume that its current baseline and that the cost of that means zero. Now, that's important because that means that if this plan passes, this could add to the deficit. Now, there's been a lot of talk of tax stimulus, if you will. The Senate plan really doesn't have all that much because even though the overall price tag of this is going to run north of $5.5 trillion, if you presume that a bulk of that is just going for extending the tax cuts, there's about $1.5 trillion in additional stimulus, but a lot of that is like no taxes on tips or changing the SALT deduction. Great for New Yorkers, but ultimately not going to be all that much stimulating to the economy. So, we just aren't really seeing much of this, these plans come together saying there's going to be a massive stimulus at the end of the year.
And correct me if I'm wrong, but isn't the Senate only here this week and then they have another vacation period of a couple of weeks? So if something doesn't happen like now, since we have to wait?
Yeah, so on the tax side, we're telling our clients, look, don't pay attention to this. You'll get the specifics in May. They'll probably figure this out in June or July. But, also the really big question is, and we're getting this from a lot of terminal clients this morning, are Republicans going to do anything to combat President Trump on these tariffs? We saw bipartisan legislation come out last week in the Senate. House legislation is coming today to try and claw back some of that authority and put that back into the congressional hands. Now, it's not going to pass this week because you're right. The Senate leaves at the end of this week and they're gone until April 28th. So that's like 400 years for the markets. But for for Washington, it's only 2 weeks. But, if you're looking for any type of relief on the tariff debate from Capitol Hill, it's not going to happen in the next 2 weeks.
I guess my question also is, why are investors still constantly so surprised by President Trump's tariff stance when, in theory, he's been real clear for a real long time?
Well, and that's exactly it. But I also wouldn't discount the soap opera portion of the White House. I mean, there are conflicting parts of the administration. You have Kevin Hassett and, Secretary of the Treasury Secretary Scott Bessent on one side saying, look, let's do a moderate approach, still have tariffs, but moderate. And then you have Howard Lutnick, our Commerce Secretary, and Pete Navarro on the other side saying, let's move forward. And when they both give conflicting statements, it's really hard for the markets to react. But what we go back to consistently is that President Trump does believe this. President Trump has been pushing out Truth Social statements all morning saying we're going to proceed with this plan. And for us, and this is just my own personal opinion, there aren't that many, when the average American only has $400 in savings, there are a lot of Americans out there that don't have assets in the market. And then whether their world changed last week to today didn't change all that much. For us, we're going to have to see sticker shock and consumer confidence changes in order for President Trump to really start thinking about changing tariffs.
All right, Nathan, thank you so much for that. I always appreciate getting your views there. Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence. He is based down in Washington, D.C. Switching over to the commodities markets, I'm looking at the Bloomberg Commodity Index. It's down about 7.5%, 8% from its, kind of that high of maybe a month or so ago here. So we're seeing some major moves in the commodity space. So we want to bring in Mike McGlone. He covers all the commodities for Bloomberg Intelligence. Hey, Mike, what are the conversations you're having with clients these days about the broader commodity space here?
Well, the key thing I've been saying for years is the inordinate burden for commodities has been the U.S. stock market going up, and then we'll see where commodities are going. So hopefully that's being relieved. But it looks like the U.S. stock market might continue going down, which means the normal deflation from inflation from a commodity. So we're in that cycle right now. Crude oil's at $60 a barrel, most notably because it went up too high, up to 130 a couple of years ago. Now it's heading lower. Average cost of production in the U.S. is around 50. Typically has to get down to 40 to shut that off. The most significant commodity that really jumped this year was copper. It made a new high, and it's been stopped out. I say that because I was an ex-trader. I probably would have been stopped out trying to short it, and hopefully I would have kept that on finally. Now it's going back down. It's the most correlated commodity. It might go down to 3. And you look at natural gas. It's the vested interest of our government for energy prices to go lower. So natural gas pumped up around 4. It's tilting lower now. I think it's more likely to go to 2, particularly because that's a vested interest of the Trump administration. That's what it always does anyhow. So if the stock market goes down, the deflationary forces from commodities will accelerate, which is where I think you get those kind of lack of inflation in the entire space.
Which is so weird because this should be good news, right? And yet it doesn't feel like it. Like the price slide feels not good versus a price slide where it's like, yay, gas prices are cheaper. Is there a difference in the kind of sell-offs that we see?
Alex, that's the perfect yeah, but because I look at it as a commodity trader, and you see it on the chat. Sometimes people get offset when like grain prices are going lower. I'm like, this is a wonderful thing. It's called superabundance. We have an excess of energy and food in this country, and they're getting cheaper. What does that really matter for? The people who vote for President Trump in the heartland, which is where I'm from, the Rust Belt. The rich people on the coast who own equities is not as important. But to me, that's the key thing that matters is all these prices are going lower. It's a normal cycle. And the question is what stops it? So the key thing we're looking forward to now is, will we get a drought this summer for grain prices to go up? And if they don't go up, they're going lower. That means lower food. So everything's tilting that way. And what, a midterm is about a little over a year over now?
Yep, absolutely right. Hey, gold finally suffering a little bit of weakness here after that strong run higher it's had. Mike, what do you make of gold here now below $3,000 per ounce?
Profit taking, backing up in a decent bull market. I mean, below 3,000 is the first kind of trigger for, I think, the responsive buyers to get back in. 2,800 is very good support. I think gold's just a decent bull market to continue higher. Did the same thing in 2008 when we had a decent rout. Managed money net positions were really long, but it's a pretty enduring bull market. Gold ETF holdings are starting to rocket up higher as people are seeing what's happening in the stock market. So I think it's a dip in a bull market. And this question, what might not knock that up a little? The key thing I want to point out is versus the treasury market, like the GLD, which is the most widely traded gold ETF, versus the TLT, which is the most widely traded bond ETF, gold's very expensive versus bonds. So I think it might, if we get more deflation in the stock market, it's going to pass that baton of deflation and risk asset appreciation to the U.S. bond market. But we'll see how that one works out.
I actually think I had a dream about gold. I don't know what that means in terms of it being at a top. I was like, oh, if it doubles to 4,000, maybe I should buy here. Full disclosure, I don't own gold. I can't because I work here and I talk about it. So I don't know. If I'm having a dream about gold, that feels like the sentiment is kind of way over the top. When does the selling become more of a I sell stuff because I gotta versus that I want to versus I don't want to own gold anymore. I want to own something else?
Well, that's the key thing. We've seen some gotta selling in gold. You have to sell what you can, not what you wanna. I think the key thing to think about is that most of the gotta selling we should look forward to is in cryptocurrencies. They've been a major competitor to the gold. Remember, the biggest ETF launch last year was in Bitcoin. It pumped it up, and we all realize it's less digital gold and much more leveraged beta. As that continues to tilt lower, I mean, there's still a lot of speculative excesses in things like Ethereum and Dogecoin and all that. Then I think that makes gold look more attractive. But right now we're in that transition. I think it's more like the beginning of 2008. And that's the way I see it. Is the bottom line is the U.S. stock market's so expensive. Gina Martin Adams and Anna Wong are still quite bearish. And I think is what happens in bear markets, you get sharp short covering rallies. But in terms of gold, I think it's going to be, by then, let's put it this way. This year it's up 15%. The stock market's down 15%. I think by the end of the year, that spread continues to widen. Gold going up, stock market going down.
All right, Mike, thanks so much. Appreciate it. Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence here. Red headline just crossing the Bloomberg terminal. President Trump threatens 50% additional tariff on China starting April 9th. So we'll have some more reporting on that coming up.
What would that be? Would that be like 85% tariffs?
I don't know how the math works there, but we'll have more reporting on that. But I think it goes to show, not only in response to that report that maybe he was considering pulling back on some of these, not only is he not considering pulling back on some of these tariffs, but he's putting out there in his statement today that he's maybe thinking about taking them even higher on China.
He puts this on Truth Social. He says also that all China meetings would also be terminated along with this 50% additional tariff on China starting April 9th. He is saying also that negotiations with other countries are taking place immediately. So take that as you will. We are still off the lows of the session for the S&P, where we're now down by about 1.6%. This is Bloomberg Intelligence. Happy Monday, everyone.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. President Trump is threatening additional 50% tariffs on China. That headline breaking moments ago. Stay with Bloomberg for the very latest on this developing headline from Bloomberg. Just another manic Monday for markets with the Dow, the S&P, NASDAQ all lower right now. Got to keep it locked into Bloomberg because these are fast-moving, fast-changing markets. We are down right now. Stocks experienced a wild swing, initially plunging 4% before rising 3% and then turning negative again. That's where we stand right now with the S&P down 1.7%. 49.85 where we stand on the S&P, down 92 points. The Dow down another 920 points. That is a drop of just about 2.4%. The NASDAQ Composite Index down 1.6%, while the Russell 2000 Index of small cap shares down by 2%. 10-year yield 4.08% with a 2-year 3.65%. Gold down $42 the ounce. Gold, spot gold now below $3,000, down 1.4%, $29.96 for an ounce of the precious metal. And West Texas Intermediate crude posting a steep decline again, with the benchmark initially falling below $60 a barrel. Right now, WTI down 2.3%, $60.55 right now on West Texas Intermediate crude. Among some oil majors, ExxonMobil down 3.2%. BP shares, the ADRs, are plunging by 6%. Chevron shares down now by 2.9%. So again, recapping, stocks are lower for now. Our next market update coming up just about 20 minutes from now, but of course, developments as they happen here on Bloomberg Radio. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pella, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, and we're also streaming on YouTube, so head over to youtube.com. Search Bloomberg Podcast Live. That's where you'll find us. I think one of the most amazing things of Charlie's report there on the markets was just the swings intraday, down 4% earlier this morning, up 3% for like a cup of coffee, as Tom Keenan would say, just about an hour ago. So the intraday volatility is really just striking here. Gina Martin-Adams joins as Chief Equity Strategist for Bloomberg Intelligence, joining us here in our Bloomberg Interactive Broker Studio. Gina, when you see that kind of intraday, even within an hour, these 4, 5, 6% swings in the broad market indexes, boy, what does that tell you?
Welcome to the bear market.
Yep.
You know, you just don't see that kind of volatility in a healthy market environment. There have been a lot of rumors flying around all morning about will we, won't we, maybe even pause the tariffs.
Yep.
Now you got more announcements coming out of Trump himself suggesting he's only going to escalate the trade war further, specifically with China. So there's just a lot of volatility reflecting what is a very changed market condition. Once we got to that 20% bogey on the S&P, it's pretty clear we're now contending with a bear market trade.
So where do we, I mean, it's a unique bear market, I would say, or because it's really the result of policy recommendations coming out of the White House. How do you play that? How do you adjust for it? I mean, I still haven't seen earnings come down that much out there. So how are you approaching it?
This is the tricky part, is we came into this year with extraordinary expectations, and really that framed the case for a more cautious view at the start of the year, which has only been amplified by now serious downside risk that results in the economy and the earnings outlook as a result of tariff implementations. You know, the only place, you know, in the equity market when you're in these periods of panic and in these periods of distress, you really want to focus on beta. What we find is lower beta sectors like consumer staples and utilities tend to perform relatively well, at least sheltering you from a tremendous amount of downside portfolio risk. Likewise, when you look across the world, the U.S. market at large is actually one of the highest beta markets right now. That's why we're seeing the U.S. sell off as much as it is, whereas other markets like Saudi Arabia, relatively stable. Brazil, up until Friday, had been a relatively stable market because it's very low beta. So beta tends to drive a lot of trends. We'll get to the point where we start thinking about recession risks. I think we've started to turn that corner already, and you'll see analyst revision momentum shift viciously negative. It already was negative because, again, expectations were too high. but analysts are just now starting to think about how tariffs really impact their numbers going into the second half of this year, because it was always an unknown until just last week.
Yeah, but even still, like if I'm a company and I got a report on Friday and I'm JP Morgan, like how do I possibly know what kind of outlook or forecast can I give? And that's just for any company, honestly.
Yeah. You know, I think if you want to be offer full disclosure, you present scenarios. Frankly,
It's like a fan chart for earnings.
Yeah, it's sort of in the end, we need to consider what would happen if these tariffs are indeed implemented and a trade war breaks out, which does appear to be what's happening right now. It's very difficult because they're reporting on earnings that happened before last week. So they're reporting on the first quarter, which was really just riddled with a lot of uncertainty, but not a tremendous amount of implemented tariffs. Now they've got to consider in the second quarter, we will likely have implementation of these new tariff rates. You know, if they are implemented, what does that mean for your outlook is a huge question mark, but we really should be considering now what it might mean for the outlook. And that's gonna be mostly in the commentary, not in the results themselves.
Right.
Gina, Tom from the Upper East Side writes in and asks, what does a VIX of 52 mean to you?
Extreme volatility has emerged in the equity market. Fear has definitely started to emerge. We very rarely see a VIX like this without sort of severe market weakness. So it's really consistent with what you're experiencing in price. Is fear has now emerged. Panic is running the show. Panic means we're going to have very volatile days as a consequence of what, you know, where markets are. So it's really just consistent, frankly, with the price trading. It's very rare to see this kind of VIX without some kind of near-term bottom formation, except for in periods like the Great Financial Crisis or the tech bubble crashing. So your risk now is maybe this is just the beginning. And I think that a lot of people are just coming around to that notion. Normally, people are buying a VIX spike that is this high. But if we're going to see significant fundamental deterioration and longer-term disruptions like the 2000 to 2002 period or the 2008 to 2009 period, this may be just the first of many.
What sector are you watching most in earnings?
Oh, tech, 100% tech. I still think it's very misunderstood how much this upending of the global trade order is going to impact the tech companies themselves. Consumers are really quick to price the consumer, or investors are really quick to price the consumer stocks implications, right? 'Cause it's very obvious. Nike imports a tremendous amount from the Far East. If those tariffs are implemented on Vietnam, for example, Nike is a very near-term recipient. But where we really struggle to figure out the long-term implications of this, I think, are going to be tech and the supply chains inside tech, which have already been extraordinarily disrupted by COVID and a lot of sort of China-Taiwan risks and some uncertainty there. I think tech is going to continue to be the bellwether. The secondary one I would watch is financials, which is actually coming up the end of this week. We've seen financials was a bit of a port in the storm in the first part of the first quarter. Now financials estimate revisions have been very negative as the yield curve has been flirting with inversion again, and the insurance space very disrupted by the fires in LA. So financials will be really interesting as well, though not necessarily a big bellwether for the market at large. That's tech.
All right, Gina, thank you so much for coming in here. Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Brokers studio. It's a great segue, as Tom would say, into our next guest, talking about technology. Woo Jin Ho, Bloomberg Intelligence Senior Technology Analyst, joins us. So, Woo, a lot of the companies you cover, the Dells, the HPs of the world, how are you fleshing out the tariff risk to those in the tech, hardware, and networking side?
Yeah, hey, Paul. So it all starts with the country of origin of the end product. So, for example, in the PC notebook side, a lot of that stuff is made in China. Roughly 85% of the notebooks are manufactured in China. So we have to account for that in terms of the tariff risk. One metric I saw earlier today by the Consumer Technology Association, they think that the average consumer laptop is going to increase 45% with the tariffs implemented. So that's going to dent demand some way or another. Now, the reason why it's going to increase is because the profit margin on a good day is 7% for a notebook. So there's very little wiggle room for Dell or HP to absorb the tariff. They're going to pass that through to straight to the consumer. Now, on the other hand of the spectrum, we're looking at exemptions. From what I've read, the GPUs will be exempted. GPUs for AI servers are going to be exempted. Now, 70% of a bill of material for an AI server is related to GPUs, and all of them are built domestically. So, you know, the AI server makers like Dell, HPE, and Supermicro, that portion of that business, they'll be able to navigate around it. They won't be immune, but a good portion of the BOM will be exempt from tariffs.
Have these stocks re-rated for this?
Well, Dell and HPQ, right? HP, they've re-rated quite a bit because of their PC exposure. Dell has about 50% of their sales related to PCs, commercial as well as consumer. HPQ, they actually have a lot of the printing business, like the ink and the papers are coming from Mexico as well. So nearly all of their business is going to be tariffed. And the other thing you need to take into consideration, some companies did not guide to include tariff impacts, Dell and HPQ. So when I think through earnings over the next couple of months, you are going to see some downward revisions.
And which, I mean, Dell, can they pass along everything to the consumer, or are they going to take something in the margin? But you talk about a 7% margin. I'm not sure what they can do there.
Well, it's operating margin, right? So you could probably pass a little bit along.
Yep.
Well, you're going to pass a lot of it along to the margin, but I don't think they want to go at an operating loss. So, you know, the offset is lower units, higher prices. Is it net? Are we talking about from a revenue standpoint, you know, flattish to slightly down? Or is the demand going to be so weak that it'll be down precipitously?
I guess my other question is, in terms of the enterprise demand, what do we know about that? And then how does that filter through then to some of these guys?
Yeah, so that's a great question, Alex, because a lot of if we're talking about servers, and if we talk about storage, enterprise side, they're actually assembled for the most part either in Mexico, US, or Taiwan, so they can actually move around the supply chain fairly flexibly. Now, if there is a recession, demand is going to be impacted. Right. There's no doubt, right? But from my conversations with the companies, they're looking at risk mitigation from a supply chain standpoint to mitigate the impact to pricing.
Woo Jin Ho, thank you so much. We appreciate that. As always, Woo Jin Ho, Senior Technology Analyst for Bloomberg Intelligence, joining us from Princeton, New Jersey. Again, look for the price of your PC potentially go up materially, so we'll keep an eye on that. S&P 500 off 86 points. That's 1.7% here this morning. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 index down now by 1.3%. This Bloomberg Business Flash brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to Commonwealth.com to learn how. President Trump is threatening to impose additional tariffs on China of 50% unless Beijing withdraws a 34% retaliatory duty on U.S. goods. Now, that 50% charge would come on top of the 34% duty the president has imposed on all Chinese imports set to begin on Wednesday. A wild day for the U.S. stock market. The Dow, the S&P, NASDAQ, they are lower right now. Stocks swinging violently, wiping out a 4% plunge to rise more than 3% before turning negative again. That's where we are now with the S&P down 0.8%, down 41 points at 5,033. The Dow down 544, down 1.4%, while the NASDAQ Composite Index is lower by 81, a drop there of 0.5. Russell 2000 Index of small cap shares, it is down now by 1.5%. The 10-year 4.11%, the 2-year 3.71%. Spot gold at $29.84 the ounce, falling below 3,000, down 1.7%. West Texas Intermediate crude right around $61 a barrel, down 1.5%. Bitcoin just about flat on the day at 78,851. Traders are betting the Fed will aggressively cut rates this year as U.S. tariffs spark fear of recession. And with that story, here's Bloomberg's Vinny Del Giudice.
Futures implied up to 5 quarter-point rate cuts. Some on Wall Street say we may see easing before the Fed's next meeting in May. Such emergency rate cuts are unusual and last employed during the pandemic. That said, Fed Chair Jerome Powell made clear he's in no rush, even after presidential goading over social media. At Rights and economist Lou Crandall pegs chances of a rate cut at or before May's meeting below 50%. Vinny Del Giudice, Bloomberg Radio.
President Trump has ordered a review of the potential sale of United States Steel to Nippon Steel, opening the door to amend a decision by Joe Biden to block the transaction. Recapping stocks lower, S&P down 0.6% for on-demand news 24 hours a day. Subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, finance, economics, politics, with our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. So Dollar Tree raised to buy from neutral over at Citi. The bank anticipating that those higher across-the-board tariffs actually could be positive for the discount retailer, that they can cover their increase in their price base in this environment with everyone else also increasing prices as well. Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail and the impact of tariffs on some clothing retailers. Have you been able to determine sort of the good and the bad and the ugly here, like those that'll benefit on a relative basis?
Well, I'm not sure about those who would benefit on a relative basis, because really across the board, most clothing retail brands have shifted their production or their suppliers or where they source the clothing to other countries outside China. Some of the big exposure includes Vietnam, Cambodia. As you know, Vietnam is at 46%, Cambodia at 49%. You also have Indonesia, Malaysia, so all of these Asian countries. So where the big concern has always been, okay, what's going to happen with the tariffs on China? And when we had the 20 percentage points go through in March, replacing the 10% in February, that basically, most of the retailers did disclose how that would impact them. Now with the 34%, and of course Trump is talking about adding another 50 percentage points on top of the 34, but just taking the 34 percentage points, and if you use the math that they give, I mean, that's like about 1.7 times more than the 20 percentage points. So, you know, you can see an impact to companies' gross margin without including the effect of many other countries, somewhere around 200 basis points or more, with the China exposure, depending on their Chinese exposure. Those with less exposure to China would be less impacted. Also, negotiations with these other Asian countries are indicating that they're willing to either go to zero or reach some sort of an agreement because they really can't afford it.
So, Mary, I don't know if we have any historical guidance here, but to what extent do you believe most U.S. retailers can pass along some or all of these price increases to consumers?
Yeah, so let's drill down on it just a little bit, because when they announce an increase, typically what happens, and if we look at what has happened in the past, in the case of China, the suppliers there agree to cover about half the cost of the tariff or the increased tariff. And so the companies that we have under coverage and that we talk to expect them to act accordingly with the latest round of tariffs. And so I think that's factored into their guidance. So when you think about the magnitude of the tariffs around the world and what the impact could be, I think there's no way they can hide from not raising prices. So they would have to raise prices.
But in theory,
basically.
If everyone's raising prices and you still then have the cheaper goods, couldn't you steal some market share from that, or is it not a zero-sum game?
Yeah, it's not a zero-sum game, because you just brought up, Alex, you brought up a very interesting point, and that is we had the de minimis provision, and what that allowed is shipments coming in from China under $800 were not subject to a tariff. So that made Temu and Shein being, a threat to a lot of these value brands, if you will, and they had lost share to them. It's fast fashion, it's stuff that you throw away, so it's not that great. But the fact is that with this tariff, they were essentially closing that loophole. And so they imposed a 30% tariff below $800. It's the higher of 30%, or I think it's $25 per item or something like that. It depends on the schedule.
And just looking at the broad swath, the scope of the tariffs in terms of the countries involved, there doesn't seem to be any place for these clothing retailers to kind of hide out. They source, while they may source things from around the world, pretty much everything's getting hit. Is that the concern?
Yeah, it is, and you can see why. I mean, so for example, if you take Gap, Gap was touting the fact that, look, we're under 10% exposure to China, but then they have 27% of their goods coming from Vietnam, and then I think it's like another 23% from Cambodia or something like that. So, we have a schedule for every single company and where they're exposed based on their disclosure. And then there's a certain percentage that's not disclosed, but nonetheless, given the fact that practically every country that Trump has imposed a tariff on every country, yeah, there's an impact. And if you look at the math, so if you look at the schedule that Trump put out, it's called a reciprocal tariff, but it also includes an impact for currency manipulation and some other factor, and that's kind of a very gray area. So the Wall Street Journal actually had a very interesting article today discussing the math, and as one who was quoted in the article indicated, could it be bad math? Nonetheless, we think that in the end, something gets negotiated and it shifts. And so I think there's some hardball tactics going on, especially with regard to China. But away from China, it seems like there's an ability to negotiate, and potentially the news could shift very quickly, we think.
Yeah, no, absolutely. I mean, we saw this earlier today with the broader S&P. Mary Ross Gilbert, thank you very much. Bloomberg Intelligence, senior equity analyst. She covers all the retailers for us. But, to that point, if we moved everything here, like we moved, say, all the textiles here, all the car manufacturing, everything over here, are there the workers with which to do that? Either to pay them a good living, and do we actually physically have the workers to make that up?
Yep. Good question. Good questions. And we have pretty much full employment today. Yeah. So I'm not sure where they come from.
Yeah, I would point everyone to Brooke Sutherland's newsletter every Friday. She was talking about this in terms of the manufacturing sector last week. A really great piece, so definitely check that out. All right, coming up, George Ferguson, Bloomberg Intelligence, senior aerospace, defense, and airlines analyst on Spirit News, new CEO.
Listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. Also check us out on YouTube as well. Let's take a look here at the aerospace industry. So this was a headline that came earlier. Apparently, Spirit Air's CEO steps down after the company emerges from bankruptcy. We're also obviously tracking the impact of U.S. tariffs on air leases and all the rest of it. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, joins us now, who, if you can't see it on radio, looks a little tan, actually.
Nice.
Have we been sunning?
Yeah, I was just down in Florida on spring break. So.
Oh, there it is. He parties with the kids. All right. Talk to me about Spirit. What happened there with the CEO?
I mean, they're not saying, but the timing just makes me think that probably maybe creditors weren't most excited about him staying as CEO, looking for somebody else. So it can't be fun days in Spirit either right now. So that'd be my guess.
For the regional airlines like of the Spirits of the world, is there a future for those kinds of airlines these days? I know the majors are, in better shape, but how about the regional ones?
So I think you're talking sort of low cost, ultra low cost, or do you mean? Yep. So
Frontier, Spirit, right?
Exactly. I think the future is looking brighter for them right now. Okay. So look, they definitely went through some difficult times. There was too much capacity at the lower end of the market, and it doesn't mean I think you can't potentially lose some of those airlines. But therein lies the healing as you start to lose some of those airlines as they either cut back like Spirit's been doing, or some maybe even fail. You cut some capacity out of that marketplace. My sense is right now too, with stock indices moving lower, people feeling a little more unsettled, with their amount of wealth, you could see a trade back down to cheaper flying. And I think that's where the low-cost carriers, really excel. And so I think there's definitely a future. The question is for how many.
Oh, that's interesting. So you don't think the big guys would discount enough to steal back market share or retain that market share?
I think they can discount some to try to keep airplanes full, but they do come with higher costs, right? They definitely have much higher labor costs. And so there's only so much they want to discount, and they've really been living pretty well, subsidizing pretty well based on that front of the airplane, capacity, those higher ticket prices. And so I think they might get a little more challenging here. I think those airlines, obviously, they still have to cover all their costs, and so I think they won't be able to discount, I think, as much as the lower end of the marketplace. The lower end of the marketplace does need to get some of the capacity cleared out, but once that's fixed, they won't be able to discount as much, and so it creates a challenge, I think.
George, what's the tariff impact in your corner of the world here? I'm thinking about the big aerospace companies. How do you look at it?
It's a mess, right? I think I was just out at a supplier conference in California. Nobody really knows. Global aerospace supply chains are very much centered in Europe and the U.S. There's a lot of movement of parts between those two regions. For example, the GE jet engine that goes into the Boeing 737 has a component of it built in France by Safran. It has a component of it built here in the U.S. They put the two together either in Europe or in the U.S. and put it in an airplane. So if we're going to tariff those components, all of a sudden jet engines are costing a bunch more money. I think we're waiting to figure out exactly how that whole thing works out. But very intertwined, so I think the tariffs become difficult to account for. Will definitely raise the prices of airplanes. Lots of customers, I think, though, don't have anything built into the contract for the manufacturers, Boeing or Airbus, to cover increased costs due to taxes, like a tariff. And so I think essentially they would be required to bear the tariff. So we'll see what they come up with strategies. The other thing is this industry is one where you could domicile airplanes in different parts of the world, potentially lease them into your fleet. Would that be a buy into a U.S. carrier? Or could you shift things around the world depending on where you're going to operate them? You can't. There's a lot of moving parts in our industry. It will have an effect if they stay in force. But I think we're still trying to figure out what some of the workarounds are and what stays in force. So I think a lot to be determined yet.
Okay, before we let you go, can you renegotiate those contracts if stuff comes up like tariffs that have no fault of their own? Does that change the game?
I think if you're in the backlog and you have a contract, no.
Okay.
I do think there's strategies where you could say, I just don't want to take delivery of the airplane or something like that. Depends how far down the road they are in building it. But I think once you have a contract, you're stuck at that price. And our new contracts being drafted so that they account for tariffs, I'm not sure the manufacturers want to bear that risk. And so could be a standoff. We could have a lot less orders in the near term while we figure out how this is going to play out.
All right, George. Yeah, uncertainty is the name of all the sector's games. George, thanks a lot. George Ferguson, Bloomberg Intelligence, Senior Aerospace, Defense, and Airlines Analyst, which is why I think earnings season is going to be so interesting from an operating margin perspective and a general profit margin perspective and the outlook for those two areas. I don't know how you give that range.
I don't know. One good thing for the marketplace and for C-suite in general, Jamie Dimon starts it. So he'll set the stage, he'll set the template for what CEOs should say, can say, that kind of thing. And I suspect, maybe some kind of scenario analysis might be in play.
Yeah, we already got sort of some preview earlier today with a shareholder letter that came out sort of urging a resolution of tariffs and saying the longer the uncertainty goes, the more irreversible all of this will be. Okay, this wraps it up for me and Paul.
Yep, absolutely.
On this Monday, just taking a look real quick here at where the equity market stands. It's been already a very volatile ride, and we've only been open for 2.5 hours. Now you got the S&P off by about 1%. Joe Matthew, a balance Balance of Power is next.
Alex, thank you so much, and thank you for being with us as we continue our commercial-free coverage here on Bloomberg Radio, satellite radio channel 121, and on YouTube, where you can find us right now live from Washington by searching Bloomberg Business News Live. This is the Monday edition of Balance of Power. It's going to look and feel a little bit different today for a reason. Coming off the weekend here with special coverage last evening and now continuing coverage with these markets on a roller coaster today. As Alex just mentioned, Dow Industrial Average down 400, and make that 735 points right now in the broad market, is down a little more than 1%. NASDAQ is down 182 points, 1.1% loss. The S&P 500 down 74 now, about 1.5%. We were positive earlier this morning following reports that suggested the president wanted some sort of a 90-day pause on the tariffs. The White House quick to call that fake news. Markets plunged sharply lower after, and then Donald Trump ups the ante again, taking to Truth Social to threaten another layer, another 50% tariff on China. If you look at Truth Social today, he says it all, issuing retaliatory tariffs of 34%, as he writes, now set if they do not withdraw that 34%, additional tariffs on China of 50% effective April 9th. Now, coming up, we have something special for you here today. In the teeth of the sell-off, a remarkable sit-down conversation with BlackRock's Larry Fink. He's going to be sitting down in a moment with Eric Schachter, and will be a bit of a seminar for us today as we try to pull back for one moment and get a sense of where we are. Before we get into that, we're going to talk to Michael McKee as well, and updating the markets right now. Charlie Pellet brings us up to date on the Monday trade now with all of this volatility. Where we are at the moment, Charlie, take it away.
I thank you very much, Joe Matthew. You set us up well. It is a manic Monday. Joe's too young to know that song, but we've got the Dow, the S&P, NASDAQ, all moving lower. S&P down 70 right now, 5,003 where we stand, down 1.4%. Dow Industrials down 740 now, drop there of 1.9%. NASDAQ down 1.2%. But the big story beyond the numbers are these wild swings for markets. Bottom line here, S&P having a 7% intraday move, biggest since 2020. One more good reason to keep it locked into Bloomberg for the latest on these fast-moving markets. Your 10-year, 4.11%. The 2-year, 3.69%. Spot gold down 54, down 1.8%. West Texas Intermediate crude with a $60 handle, 60.58, down 2.3%. Bitcoin down 0.7%, 78,242 on Bitcoin. Balance of Power continues right now, and back we go to Washington. And once again, your host, here he is, Joe Matthew.
All right, Charlie, thank you so much. Whether you're with us for the driveway moment on the radio or our visual feast here on YouTube, we have a lot for you straight ahead. As I mentioned, importantly, and this is going to start in just a couple of moments, Bloomberg's Eric Schachter sits down with Larry Fink on this day that Donald Trump ups the ante again on tariffs, threatening another 50% on China if Beijing does not take off the retaliatory tariffs. And it's a good opportunity to compare notes for a moment with Bloomberg's Michael McKee, who joins us live from New York here in the midst of it all. Mike, it's great to see you. We're coming off a weekend in which a lot of people were very afraid about what was going to happen this morning. Case in point, the volatility we have seen here. It's hard to describe the mood that investors are in, but it looks like this is a White House and a president that's standing by its guns.
I think that's a fairly safe assumption, Joe. Everything the president has said this morning, and he's been tweeting on a regular basis, suggests that he is continuing down the same path. The problem is everybody needs to know when that path ends and where does it end, and there doesn't seem to be any information on that. You're right about the way the markets have traded today. I noted in a tweet that it looks like a toddler crayoning on the wall, up and down and up and down. We had that false report that got put out on social media about a 90-day pause. And then as soon as that was debunked, the markets went way down again. They started to come back up, and then Trump tweeted this additional tariff on China. So he clearly seems to want the markets to know that he is serious.
The top headlines on the terminal say everything, right? If Donald Trump isn't the market, I don't know what is. Trump vows additional 50% China tariff over retaliation. Stocks swing wildly with tariff headlines sparking volatility. Wall Street titans blast Trump's tariffs with markets roiled. Big take. Wall Street, collateral damage in Trump's trade war. He didn't write it like this in his head before this happened, did he?
No, I don't think so, but I suspect, given what we're seeing from him, he is enjoying it and enjoying the power he's wielding over Wall Street. There was a New York Times story yesterday to the effect that the Wall Street Titans are getting very upset and they're getting very worried about what could happen here. So he does seem to be throwing spaghetti at the wall and enjoying watching it stick.
Boy, it's great to have you with us, Michael McKee. At high noon on the East Coast, we want to turn now to our colleague Eric Schatzker, who, as I mentioned, is sitting down with the Chief Executive Officer of BlackRock, Larry Fink. This is live on Bloomberg.
Than anything else, we're fine. I mean, look at in our 37 years of running BlackRock, we're not focused on the day-to-day. We try to consistently talk with a narrative about long-termism, working with clients in the long run. I mean, obviously, things, when you see a 20% market decline in 3 days, obviously it has significant impacts and the ripple effects of the potential of tariffs is going to be long-standing. And so our job right now is to just be, we're having more conversations with clients. Probably the last time we had this many client conversations at BlackRock was right when we closed our economy in March of 2020. And this is the type of time where we really try to connect. We manage money for people in 106 different countries. We have offices in 36 countries. So what we need to be doing every moment is bringing all this global information that we gather with $11+ trillion of money and hearing and paying attention to the flows and where the money is going. But the magic sauce of BlackRock is the last 20% of being local and being really connected to each and every client worldwide and try to really add to them. So we're bringing all this global information, but we really try to be local in every community where we operate and work. And as a fiduciary, our job is to be helping Canadians right now. Our job is helping Europeans now. Our job is to be helping Americans now. And so, obviously markets are down 20%. So some stocks are down over 30, 40% from their high water marks of just from January. But in the long run, I would say in the long run, this is more of a buying opportunity than a selling opportunity. That doesn't mean we can't fall another 20% from here too. But I do believe over the long run, the vitality of the United States will persist. And I'm still proud in terms of working with every investor worldwide.
When you just said it doesn't mean that the market can't drop another 20%,
Yeah.
a bit of a gasp go through the audience.
I won't like it, but it's not going to, but unlike most, like let's say 08 and 09, you don't see the leverage in the system. You don't see systemic risk. You see, this is more geopolitical issues. Look, the fundamental issue that we're all trying to recognize, post-World War II, the United States was a global stabilizer. And I've been now in July will be my 49th year in finance here in New York City. And that's been one of the foundational tenets of I would say the financial community, that we live and work and grow with our economy. And one of the main foundations of the U.S. that we are a global stabilizer. Obviously, in the last week, we have not been a global stabilizer. We have, and I think that is something that is this going to persist? Are there going to be new global stabilizers in the world? Well, if there are new global stabilizers in the world, and I'm not suggesting there will be, these are questions that must be asked. What is the role of the dollar in that ecosystem? So there's a lot of questions that we need to be asking ourselves. But, 80 days ago in Davos, the phrase was American exceptionalism you heard everywhere. I would say probably every meeting I went to, everyone is focusing on how to do more in the United States. And obviously that's been thrown out right now. Obviously you can look back and say that was, just irrational exuberance of too much related to the US. And so that we are seeing a recalibration. 75% of the market value, this was before the last few days, 75% of the market value of the global capital market was here in the United States. Can there be a reordering of that in the short run? Maybe in the medium term? Sure. And so all of this is the type of questions. Clients have historically underweighted Europe. Okay. So far this year, that's been a bad trade. Should clients be reorienting themselves back into Europe? Should they be reoriented into more of a more broadening of a portfolio? So all these questions are being asked, and I don't have a good answer yet, but I am troubled by that we are not the stabilizer as a country. We are destabilizing. And I think this is what the financial markets are trying to grapple with.
There are, let's say, at least a couple of competing narratives. One of those narratives is from President Trump himself. He says that the tariffs he rolled out last Wednesday in the Rose Garden will create an economic renaissance and make America wealthy like never before. And then the other narrative is the public market narrative. That's the one that's telling us something altogether different, that the tariffs are an economic train wreck in the making. And if anything, they'll make not only the US, but perhaps other countries a lot poorer. Which of those narratives is right?
It's probably something in between, but as a market participant, I'm more in the market narrative. So let's be clear. In the United States right now, 8%